Okay, so we finished yesterday talking about minor beneficiaries. Let me get here. We talked about common disaster clause. We discussed that. We discussed the fact that minor beneficiaries really not a great idea. So the next thing we're talking about is mode of premium. Now, mode of premium, this is not like pi a la mode, huh? This is mode meaning frequency, a frequency of payment. And in the world of insurance, people, depending upon the policy, can pay as frequently as weekly. Most often, people pay monthly. Once in a while, they'll pay quarterly, semi-annually, or annually. So mode of premium is the frequency with which people pay their premium. In life insurance, it's usually either monthly, quarterly, semi-annually, and annually. With health insurance, that might also be weekly. Now, I think I mentioned this earlier, sometime yesterday, when insurance companies calculate their premium, they make the assumption that everybody's going to pay the premium on an annual basis. Therefore, if someone wants the convenience of paying more frequently, then they're really going to end up having to pay more by the time the year is up. So the monthly premium is generally not 1/12 the annual. There's some factor they build into that. It's about 0.09% or something, because they have to make up for the lost interest and the administrative costs in handling more payments. Okay, so you may get a question about why are the premiums more by the end of the year if you pay monthly, quarterly, or semi-annually as opposed to annually. Well, the insurance company is going to lose interest on the money they would have had if they had it all year, and then of course it costs more to deal with somebody. By the more times they have to deal with it, the more it costs. So anyway, that's the reasoning for that. Now let's talk about grace period. And grace period is not a period of time that you pray that they pay. It's got nothing to do with that. It's got to do with how long after your premium is due. Your premium is due on a certain date. So how long after your premium is due do you have to still make your payment before you lose your policy, before it lapses? Well, in life insurance, the grace period is 31 days. So you have 31 days from the date the premium is due to still make your payment without incurring any penalties or any costs. And during that grace period, the policy is still in force. So if someone dies during the grace period of their life insurance policy, the insurance company is still going to pay the benefit. But they're going to deduct any unpaid premium from that death benefit, because the premium should have been paid at the beginning of that period when the premium was due. So you may get a question about how the grace period works. Now understand, with life insurance, it's 31 days. If a claim comes in if a person dies during the grace period, they haven't paid their premium, they'll still pay the death benefit, but they're going to deduct the unpaid premium from the death claim. In health insurance, the grace period is treated differently. In health insurance, the grace period is determined by the mode of payment. So as you can see, the mode of payment for grace period for health insurance could be weekly, monthly, quarterly, semi-annually, or annually, and the grace period is different for each of those. So if someone wants the convenience of paying weekly, then their grace period is 7 days. Monthly, 10, quarterly, semi-annually, and annually, 31 days. But the same rules apply. If a loss comes in during the grace period, the policy is still in force. They're going to pay the claim, but deduct any unpaid premium from the claim. These are mandatory provisions. The grace period provision are the mandatory provisions we discussed yesterday, and they're mandatory because it really protects the consumer. When somebody says, well, how does this protect the consumer? Well, it keeps the policy in force. You see, it gives the opportunity for the insured to make their payment. Plus, even though they're going to pay the claim but deduct the unpaid premium, that keeps the policy in force for future claims. If all they did was pay the claim and the individual never made their premium payment, they would lose their policy, it would lapse. So it's really in the customer's best interest to go through this process that I refer to as pay but deduct. So here's a question. If the premium on a health policy is paid less frequently than monthly, what's the grace period? I'm going to give you a minute or two to look at that. Remembering the grace period on health is depending upon the frequency of payment. So the premium is paid less frequently than monthly. What's the grace period? I'm not asking you to yell out an answer, but here I'm going to give you that answer right now. It's 31 days. In my live classes, I get people to respond, and many times they respond with 7 days. But what happens is that they looked at the question, they saw the word less, and they went to the lower number. That's a common error people make. But it's reading it carefully. I know you can see it. It means less frequently than monthly means you're paying it quarterly. Okay? If you're paying quarterly, then you're paying less frequently than monthly, quarterly, semi-annually, and annually. That creates that 31-day grace period. So this is the kind of stuff they do on the test, and that's why it's important to go through those practice exams so you get used to this kind of stuff, and you'll see why the answers are what they are, why it's so valuable. And by the way, I did send out an email. I hope everybody got it with your login credentials, how to get into this, the website to go to, and you should go there as often as possible. That's really the place you should be spending most all of your time in preparation for this test. Anyway, I hope that part makes sense to you here. Now, once a life insurance policy goes beyond the grace period, it's going to lapse. That's also true, by the way, with health insurance. But with life insurance and health insurance, there's an opportunity to get to reinstate the contract. They have a process whereby the insured, the owner, can reinstate the contract. In life insurance, the reinstatement process involves a couple of things. Number one, the insurance company must allow the insured to request a reinstatement within 3 years. So if that policy has been lapsed and it hasn't been paid for, the owner has up to 3 years to ask the insurance company to reinstate the original policy. That doesn't mean they're going to reinstate it, but it means that they have to at least entertain the request from the insured to reinstate the policy. Because you see, they're not going to welcome you back like the prodigal son. They want to make sure you're still insurable. I mean, they're kind of saying to themselves, why do you want this thing back? Yeah, you all of a sudden wake up this morning coughing up blood. Yeah, you've been diagnosed with a fatal illness. So they want to make sure you're still insurable. So maybe you have to go through another physical exam and prove you're insurable. Also, to reinstate that life policy, you'll have to make all past due premiums plus interest. And if prior to the policy lapsing you had any loans that you had borrowed money from the general account of the insurance company, they have to be repaid. They want that contract restored to its original place. So people ask me, well, why bother reinstating? Why don't we just buy a new policy? If I have to qualify, I might as well just buy a new policy. Well, here's the challenge, and this may be presented to you on the test. The challenge is this: supposing I bought that original policy when I was 25, and now I'm 70. Yeah, if I'm healthy enough, I can get the policy back, but I'm going to be paying the premium as a 70-year-old. If I reinstate the policy, it might be worth it to me financially to pay all past due premium plus interest, because I'm now going to have all my cash values restored, and I'm going to be paying the premium that I was paying when I was 25 years old. So there's generally a very good reason from a financial point of view to reinstate the policy rather than buy a new one. I hope that makes sense. So reinstating a life insurance policy, basically you have to prove you're insurable, pay all past due premium plus interest, repay any outstanding loans. The phrase you may see on the test, the policy is restored to its original place. And there's a value perhaps in restoring the contract, okay? Well, now health insurance reinstatement is treated a little differently. You still have to make application and prove you're insurable again, but there's no requirement to make any past due premiums. But the company has 45 days to decide whether or not they're going to reinstate, or automatically reinstates. So the company basically has 45 days to or get off the pot on a health insurance reinstatement. There's no values to restore, nothing, none of that, nothing of that sort. So health insurance reinstatement, life insurance reinstatements, yes, they're certainly possible, but in both cases, person has to prove they're insurable. In life insurance, pay all past due premium plus interest, repay any outstanding loans, and what's the value there? Well, you're going to get to restore your contract, meaning your premium stays what it was when you were younger, and all your cash values are back. In health insurance, the company has 45 days to make a decision, or it automatically reinstates. That's the difference in those two. Now, misstatement of age or gender. I know this is going to shock you, but people will lie. Yeah, people will lie, and they get caught. So if the insurance company finds out after the policy's in effect, or in a life policy after somebody dies, that they misstated their age or their gender, the insurance company is going to adjust the benefit to pay what would have been paid had they known the correct age or gender. It's a kind of a no harm, no foul thing. It's not that they would have denied you because you're a woman or a man. You would have just paid a different premium, and that premium would have created a different benefit. So in life insurance, if a person dies and they find out after they're dead that they were a different gender, they're going to adjust the benefit accordingly. If they were a woman, but for somehow said they were a man, they were paying higher premium than they should have, so they may get a greater death benefit. And if it's the other way around, then the death benefit might be reduced. So they will adjust the benefit. You get a question about misstatement of age or gender. If the insurance company finds out about it, they will adjust the benefit. And it's gender at birth. We're not into the political correctness here. The issues they're having in North Carolina and other places about, same gender back. They don't do that in the insurance world. They're still in the real world here. And they have to deal with the reality of mortality and morbidity. That's the way that works. Life insurance policies. Remember, with cash value policies, people can borrow money from the insurance company's general account if there's enough money in the cash value. Well, there's a provision in especially whole life policies that says if a person inadvertently misses their premium payment, they went beyond the grace period, where normally the policy would lapse. If there's enough money in the cash value, the insurance company will create an automatic loan to pay the premium. It's referred to as automatic premium loan. The idea would be that it's a help to the insured in case they, just inadvertently miss a payment, to keep that policy in force. Obviously, it can only work with cash value policies because you can only borrow money using cash value policies. Of course, it's an interest. I mean, it's a loan, so interest is going to accrue. It's got to be paid. Temporary reduction of the death benefit because it's still a loan against the death benefit. They just, it's going to reduce the death benefit if you die while the loan is outstanding. No 6-month waiting period. Now, I did not discuss this when we talked about policy loans. I save it for now. Because whenever someone wants to exercise their right to use the cash in their policy to borrow money from the insurance company's general account, the insurance company, in the fine print of the contract, has the right to make a person wait up to 6 months before they release the funds. Now, frankly, if I have an insurance company that's making me wait 6 months, I'm looking for a new insurance company. But there is that provision, and you may see it on the test. When it comes to policy loans, generally speaking, the insurance company does have the right to not fund that loan for up to 6 months. However, with automatic premium loan, there is no 6-month waiting period. They can't do that. I mean, let's face it. If they make you wait 6 months, the policy's going to lapse. So that's why I bring it up now, so you can see the difference between the two. So with automatic premium loan, insurance company cannot exercise that fine print thing about 6 months. They got to issue the loan if you can qualify for it by having enough cash so that the policy stays in force. An exclusion is an insurance company's excuse not to pay. Now, Insurance companies do not want to turn people down, but they have to take into account the risks that they're presented with. So folks who fly around in their own private planes, as a rule, they pose a little higher risk to insurance companies than private airline airline pilots. The regularly scheduled airline pilots don't pay any extra money, generally speaking, because that's a safer method of travel than running up and down the interstate. So there may be an exclusion for aviation, especially when it comes to private pilots or those who have hazardous occupations or avocations. Okay, skydiving, scuba diving, bungee jumping. So they may not decline them, but they may make them fill out a questionnaire, kind of like what I discussed with my client in California and the scuba gear thing. So they may exclude, but they also may accept the risk, but charge a higher premium. Now, war and military service. There are no exclusions in Virginia when it comes to war and military service, as there are in some states. Some states will not issue a policy to anyone in the military, just the way it is. If they, in some states, have a provision in the policy that's called a status clause, and the policy is issued, the guy may have a policy, or gal, but if they die while they're in the military, the insurance company's not going to pay the claim because their status active duty, not paying it. It's kind of weird. I don't know too many states that have it anymore, but Virginia does not. Some states have what's called a results clause. And if a person is killed as a result of hostile action, then the insurance policy will not pay. The presumption is that they've got military insurance to do that. Well, when I was in the Marine Corps, my insurance policy that they provided us was like $5,000, not a whole hell of a lot of money. But in any event, just understand, Virginia, if you get a question about exclusions for war and military service, there are none in Virginia. The only exception is if some active duty military person has orders to deploy, then the insurance company will not issue an insurance policy. It's not going to take away what they have, but it won't issue a policy. So if they try to buy a policy of life insurance, knowing they're going to deploy into hostile territory, the insurance company is not going to issue that policy. But that's the only exception in Virginia, if they're holding orders to deploy. And you may get that question on a test. Suicide. Life insurance policies will pay if somebody commits suicide. Contrary to what television stories talk about, they will pay if somebody commits suicide. However, they got to wait 2 years, because if somebody commits suicide within 2 years after the policy is in effect, there's no death benefit. The insurance company will refund the premium that was paid. They'll refund that to the beneficiary. But if they are willing to wait 2 years, if they can hang in there for 2 years before they kill themselves, then the insurance company will pay the death benefit. So there's a suicide clause, and it's 2 years, just like that incontestable clause. After 2 years, the contract becomes incontestable. Well, after 2 years, if somebody commits suicide, the insurance company will pay the death claim. Waiver of premium. This is a rider that's added to policies. We talked about riders, and it costs extra money. And we generally have to add it when we purchase our policy. In life insurance, I may have covered this, but if I didn't, we're going to cover it anyway. Even if I did, we're going to cover it again. So in life insurance, if somebody becomes totally disabled, the insurance company will say, oh, you have purchased this waiver of premium rider. Okay, well, here's what you have to do, Mr. or Miss Insured. You must make your premium payments for 6 months. Even though you're totally disabled, you have to make your premium payments for 6 months. But at the end of the 6 months, if you are still totally disabled, we're going to give you back the 6 months premium you paid, and we're going to waive your requirement to make any future payments for as long as you're totally disabled. Now, if you're disabled prior to 65, that rider is helpful. But if you get disabled at 65 or older, that rider falls off the policy. Think about a rider falling off something. So the rider is no longer there for disability for waiver premium at 65 or beyond. But the point is this, don't misread the question. If it's when does the disability begin? If the disability begins at 65 or older, then there is no rider to benefit from. But if the disability begins before age 65, then they will waive the premium for as long as you're totally disabled, no matter how long that is. Okay, like in whole life, we pay the premium till we're 100. So if we become totally disabled at 45, and we've paid the 6 months, and then we got that 6 months back, and we are then ultimately totally and permanently disabled, like we have that presumptive disability we talked about earlier, then the insurance company is going to waive your premium for the rest of your life. That policy premium will be paid. The policy will continue to grow cash values. You still have a death benefit, so nothing changes. It's really a great rider to add. Now, in life insurance, there's also waiver of premium with disability income, which means you can also receive a few dollars every month because you're disabled. It's based upon the a percentage of your death benefit. Guaranteed insurability rider. For some reason, I have a feeling we discussed this, but maybe I'm confusing one day with another. But anyway, doesn't hurt to hear it again. So a guaranteed insurability rider means you can buy more of the same at specific dates or events. These are life insurance. These are life insurance, not health insurance. Then the pay-or benefit. The pay-or benefit. A pay-or benefit provides a benefit that keeps the policy in force if the payer dies or becomes disabled. These are juvenile policies. We buy a policy on our child, and the payer is an adult. And if the adult payer dies or becomes disabled, the premium will be waived until the child turns 21, and then the child picks up the premium from that. These are on juvenile policies. Somebody answer me. Did we cover did we cover these on an earlier slide? Are these duplicated? I just have a recollection that we did. So let me know, but I'm going to continue. I just want to know so I can fix it for later. All right, accidental death and dismemberment. Accidental death and dismemberment. These are two different provisions, two different riders. In life insurance, if we add accidental death to our death benefit, that means if someone dies by accident, the death benefit might be doubled or tripled. So if I have a $100,000 life insurance policy, if I die with a heart attack, it'll pay $100,000. If I have the accidental death rider and I die in a car wreck, it'll pay an additional $100,000 because I died by accident. Accidental death and dismemberment, different. Accidental death and dismemberment says it'll pay if I die by accident or if I get dismembered. Okay, so I think we discussed this thing about principal sum and capital sum. I believe we discussed this, so I'm not going to go over it again. I believe we discussed it. If that policy pays out the full amount, they call it the principal sum. If the policy pays out less than the full amount, capital sum. My recollection is we discussed this when we talked about buying a $10,000 AD&D policy, and they died by accident. It'll pay out $10,000. That's the full amount. That's called the principal sum. If they lose a limb, they're not going to get the full amount. They're going to get the partial amount. That's called capital sum. And I think I discussed presumptive disability, total and irrecoverable. We did discuss it. Great. Thank you. Good. I'm not going to go over it again. All right. So we covered that. And guaranteed insurability rider. I don't know. There must be some duplicates in this slide. Okay. Buy additional policy without evidence of insurability at specific ages. I believe we touched on this as well. So we're going to continue. We also talked about term riders. I'm going to have to review my my slide presentation to see why I have this duplicate in there. I don't know why, but I know we talked about these as well. We talked about accelerated benefits. We're not going to go over that again. Wow, what's going on here? Somehow or other, I got involved. Policy options. So here's where we need to be. Policy options. These I know we didn't discuss. Policy options, also referred to as non-forfeiture options. Cash value policies provide opportunity for the insured not to lose their money. So in a cash value life insurance policy, the cash value in the policy belongs to the owner of the policy. So if the policy lapses by non-payment of premium, those values don't get forfeited back to the insurance company. They have to be made available to the owner. So we define a non-forfeiture option kind of this way. The values are not forfeited if a policy lapses for non-payment of premium. Then we have what are called dividend options. And we talked sometime yesterday about mutual companies, participating policies, paying dividends. Well, the owner of the policy has some options on how to receive those dividends. And every year they can change how they want to receive the dividend. We're going to get into the specifics shortly. And then we have what are called settlement options. When someone dies, the beneficiary gets to choose how to receive the death proceeds. So settlement options are usually chosen by the beneficiary. There are a number of options. The normal standard option is just take the lump sum, but there are others as well. So we're going to take some time now to discuss non-forfeiture options, dividend options, and policy settlement options. And the idea here is we're dealing with money. When you see a question about options, it's about money. So non-forfeiture options. One of the non-forfeiture options is called cash surrender. Cash surrender. So if a person reaches the point that their policy is beyond the grace period and it has lapsed, one of the options they have is the insurance company say, you can have the cash in your policy, but you can no longer have your death benefit because the policy lapsed. So you're going to think about it this way. You're going to surrender your rights to the death benefit, but you're going to get your cash. That's called cash surrender. A second option available under the non-forfeiture options is to take a reduced paid up death benefit, reduced paid up death benefit, where the cash in the policy would be used to buy a policy with a lower death benefit than you already have. I have an example here to show you. So you're going to get a lower death benefit for life. Reduced paid up means lower death benefit for life. Then extended term means they're going to turn that whole life policy into term insurance, but not for the rest of your life. You're going to get the same benefit, same death benefit for a period of time. So right now, what I want you to lock into, you may make note on your slides to memorize the non-forfeiture options: cash surrender, reduced paid up, and extended term. And the difference among those three: cash surrender says you get your cash, but you surrender your right to the death benefit. Reduced paid up means you get a lower death benefit for life. Extended term means you get the same death benefit for a period of time. Now, I want you to make another note. This will be helpful to you. Alongside of the reduced death benefit, I want you to write these words: coverage for the longest period of time. Coverage for the longest period of time. Coverage for the longest period of time. And then alongside the words extended term, I want you to write the most death benefit. The most death benefit. Because the owner gets to choose which of these they want. If they choose extended term, it's going to give them the same death benefit for a period of time. So it's a greater death benefit available than if they choose reduced paid up, because they're going to reduce the death benefit. But if they choose reduced paid up, they're going to get a death benefit for life. So it's going to be cover you for a longer period of time as opposed to extended term, which gives you the highest death benefit. You may get a test question about the difference between those two. So here's an opportunity. Here's an attempt by me to try to clarify what we just did. Let's assume we have someone who has a $50,000 whole life policy. Let's assume they're paying $600 a year. And this is a chart that is in many, available to most people who have whole life policies, that shows them at the end of at the policy year how much cash surrender value they're going to have, what reduced paid up options they have, or how long they can keep their policy in force as term insurance. Let's go with cash surrender or loan value. Let's do that one first. Let's fast forward to age 15. We got 15 years into this policy. And in 15 years, we're going to assume this person has accumulated $8,100 in cash. The cash surrender value means if he surrenders the death benefit, he'll get $8,100. The loan value part is saying to us, if the customer doesn't surrender his policy, he's going to keep the policy in force, but he wants to borrow money from the insurance company's general account, that is the number they're going to base the loan on. So if they're going to charge him 6% interest on the loan, they're going to give him 94% of that $8,100, the way we discussed it when we discussed policy loans. So let's go through a little scenario here. So our client calls up the insurance company and says, I no longer want to pay for this policy. What are my options? The insurance company says, well, you've got three choices. You can turn in the policy and we'll send you a check for $8,100, cash surrender. Or you can keep your policy in force for the rest of your life. And we'll take the $8,100 and we'll turn it into a whole life policy with a death benefit of $21,750. So we're going to reduce your death benefit, but it'll be paid up. You don't have to make any more payments. Or you will take the $8,100 and we'll let you keep your $50,000 death benefit, but we'll only pay that death benefit if you die anytime in the next 18 years and 8 days. If you choose the extended term option, in other words, we'll extend your death benefit as term insurance for 18 years and 8 days. If you die 18 years and 9 days from now, your family's getting nothing. It's your choice, owner. Which one do you want? Whichever one he or she chooses, they do get value for the $8,100 cash. They take the money, they get a reduced paid up death benefit for life, or they keep the same death benefit for a period of time or a term. That's the non-forfeiture options. The owner gets to pick that. Now, remember we talked about first in, first out. I want to make sure we have a little better understanding here. This is a good chance for me to help you hopefully explain a little bit better. So let's do some math here. Let's do some math. The premium was $600 a year, and he paid that premium for 15 years, which means the premium he paid was $9,000. That's his basis. Question for you, and I'm not expecting you to yell out an answer, but a question for you. If he chooses the $8,100, I don't know what happened, why it did that. If he chooses the $8,100, will he pay any tax on the $8,100? Answer is no, because based upon the first in, first out rule, even though some of that is tax deferred growth, his basis is 9, he got $8,100, he pays no tax. However, if that number happened to be $9,100, then he would pay tax on $100. I didn't say he'd pay $100 in tax. I say he'd pay tax on the $100 because that would be considered his gain. The first money in is his basis. That would have been $9,000 if this number was 9. And then that's the first money out. What's left is his gain. He'd have to pay tax on his gain. That's first in, first out. That's the way it works. I hope that makes a little bit more sense. Dividend options. So every year, hopefully, and generally speaking, mutual companies, participating policies will provide a dividend to the owner of the contract. Let's assume it's $500. So the owner can say, thank you very much, send me a check. They'll send him a check for $500. Or he could say, take the dividend you're going to pay me and apply it to my premium. So they're going to reduce what I have to send you. They call it reduce the premium. If his premium is $1,000, then he's only going to have to send in $5 because they'll apply the dividend to his premium. Or he could tell the insurance company, hang on to the money, just open up a little savings account for me there at your institution and pay me interest on it. That's called accumulated interest. Now the dividend, remember, from a mutual company's participating policy is not taxable, but any interest earned on that dividend will be taxed. So the interest is taxable, but the dividend is not. Or he could tell the insurance company, use that $500 to buy me an additional whole life policy. It may not be for much money, but I'd like the additional whole life policy. So they'll do it for him. I had a client years ago when I was younger. He bought a $50,000 whole life policy from me. I was working with New York Life at the time. That's a mutual company. So he had some options as to what to do with his dividends. He chose paid up additions. So instead of receiving his dividend in cash every year, they bought him an additional life insurance policy. And he died. He died about 10 years later. And his family got about $63,000. That extra $13,000 was a result of the paid up additions that were purchased as a result of his use of his dividends. So those paid up additions don't have any effect on his original policy because they're buying additional policies. Okay, they're additional policies. So you may get a question about paid up additions. Does it have any effect on the original policy? None. Why? Because it's an additional policy that's doing its own thing. Or he could tell the insurance company, use that dividend as an additional premium to pay up my current policy more quickly. That does affect the original policy because it pays it up sooner. And the last dividend option you need to know about is called 1-year term. And the owner can say, you know, that $500, I have a need this year. I'm getting ready to do something, and I need extra life insurance, but only for a year. How many dollars of life insurance will that buy me if I buy 1-year term insurance? Insurance company will say something like, well, yeah, well, a year, $500 might buy you another $50,000 worth of life insurance for a year. Fine. He takes that. So it's 1-year term. So the owner has the choice to pick any one of those each time a dividend is declared. What you need to know is how they work. What are they? So I've developed a little acronym, CRAPO. Help you remember, I hope. I used to have 1-year term at the top. It was, oh crap, I got tired of it, and I put the 1-year term at the bottom. So what are the dividend options? Take the cash, or apply it and reduce your premium, or let it accumulate with the insurance company at interest, or use it to buy a paid up additional policy, or use it to pay up your insurance policy more quickly, or buy 1-year term. Those are the dividend options, and the owner can change their mind each year. So now we got a little challenge, however. I got to make sure you understand this. We just talked about two kinds of options, dividend options and non-forfeiture options. And you may or may not have caught this, but the terminology that's used to identify dividend options is very similar to the terminology used to identify non-forfeiture options. So non-forfeiture option, remember, cash surrender? Well, we have a dividend option called cash. The non-forfeiture option, reduce paid up. We have dividend option called reduce premium, paid up additions. The terminology is similar. Paid up insurance, extended term, 1-year term. So I find it happens very often that in the contract, on the test, you may get a question that asks something like, which of the following are dividend options? And they mix up the ones that sound alike. And people get confused. Or which of the following are non-forfeiture options? The same thing. So my suggestion to you is what I said just a few minutes ago. Memorize the non-forfeiture options. Cash surrender, reduced paid up, extended term. If you memorize those as non-forfeiture options, and you get a question similar to what I just told you, then by default, you'll know what your answer is. I mean, you could try to memorize these 8 and separate them in your brain, but that, in my experience, turns into mashed potatoes. So memorize these 3. That's my suggestion as non-forfeiture option, cash surrender, reduced paid up, extended term. And if they ask you the question similar to what I just went over, if it doesn't fit exactly one of those 3, by default, it becomes a dividend option. I hope that makes sense to you. Settlement options. Now remember, settlement options are chosen by the beneficiary. And that's what method, how does the beneficiary want to receive the death proceeds? Well, the normal is just give me the check. Thank you very much, lump sum. But sometimes, and in my experience, this is true. There are people who have never seen more than $500 in a pile, and then all of a sudden they find out that Uncle Joe named them as a beneficiary on their life insurance policy, and they got a check for $500,000. And they, frankly, sometimes just freak out. They don't know what to do, so they need time to take a breath. So the insurance company will give them that option by saying, well, what you can do if you want, while you're trying to decide what you want to do, let us hang on to it. You're not going to lose it. And we'll pay you interest on that money while you're waiting. It's called an interest-only settlement option. Now, remember that interest is going to be taxed, but they'll send him an interest periodically on that account for as long as he wants. And anytime he wants his money or any part of his money, he can have it. Kind of like having a savings account at a bank. Or the insurance company will say, here's another choice you can have. We could take that death benefit and break it into equal payments over 10 years or 20 years or as long as you want. That's called fixed period. How long do you want to receive the money? We'll break it into payments of principal and interest, equal payments for however you want. You want it for 20 years? Fine. A fixed period of 20 years. And they'll do the math and they'll decide how much he's going to get every month so that each month he's going to receive partial principal, some of it interest, and little by little, by the end of 20 years, the principal is gone. Or the insurance company say, tell us, how much do you want to get every month? We'll send you a check every month until the money runs out. Pick a number, $5,000 a month, $7,000, $10,000, whatever you want. It's going to be principal and interest once again until the money is gone. So the amount attributable to principal is not taxed because it's still death benefit. The amount attributable to interest is going to be taxed. Pretty simple concept. So interest only. Remember, interest is going to be taxable. Beneficiary, however, if they choose that, subsequently, ultimately, will receive more than if they just took the lump sum because of the interest. There may be a question about if the beneficiary chooses interest only, will they receive an amount of money that will be more than, less than, or equal to the original death benefit? Obviously, I would think you could see this. The answer is more than. But the proceeds are going to stay the same because they're not tapping into his proceeds. They're just sending him interest on those proceeds. So one of the questions you may get is, if the beneficiary chooses interest only, what's happening to the death benefit? Is it going up? Is it going down? Or is it staying the same? It stays the same. Fixed period. Again, some of that payment is going to be interest, so the interest is taxed. And once again, because of that interest, the beneficiary is going to get more. The difference now is the payments are going to be equal, P&I, principal interest, until the end of a specified period, and then there's no more money. So the principal is decreasing over time, isn't it? And the same is true with fixed amount. Interest is taxable, beneficiary gets more, and there's equal P&I payments until the proceeds are exhausted as well. So just understand the difference. I don't think it's rocket science. I believe you should be able to get it. I don't want to insult your intelligence, but I want to expose you to the kinds of questions they may ask you about it. So there's a little chart here that explains or compares those three things. With interest only, fixed period and fixed amount, interest is always taxed. With interest only, the principal remains constant. With fixed period and fixed amount, the principal decreases it to zero, but the beneficiaries are always going to get more. Then there's another option, one more option that the beneficiary has. It's called the life income option. This means the beneficiary is going to ask the insurance company to send them a check for as long as they live. Well, think back. Yesterday we discussed what is it that provides an income for as long as you live? Answer, an annuity. So what will happen is that the owner, the beneficiary, will give the insurance company the money and open an annuity. So the same options we discussed with the life options from an annuity are the exact same options that the beneficiary will choose from if they chose the life income options. Why are we doing this? Because on the test, sometimes they try to confuse you by focusing on life income options from the death benefit of a life policy. And if you're not thinking about it, they're really nothing more than annuity settlement options. So once you understand and have mastered those annuity settlement options, you know the life income options from the death proceeds of a life policy, because it in fact becomes an annuity. Life only, refund life, life with period certain, joint life, joint survivor life. So nothing new on that realm, in that realm. Let's talk about some taxes, retirement, and some other concepts. Before we get into the taxes and retirement, we're going to do the other concepts first. The other concepts we're going to first talk about is business uses of life insurance. We touched on this earlier yesterday, but now we're going to drill down and talk a little more detail. We discussed the idea of a buy-sell agreement yesterday. How partners in a business should sit down with sit down with an attorney and draw up this document called the buy-sell agreement. We talked about key person life insurance, and we talked about split dollar. But we're going to get a little more in depth on these. We're going to first talk about buy-sell. When we let's assume, let's see. There are five of us on this call. I'm sorry, 4 of us on this call. So let's assume the 4 of us decide we're going to form a partnership. We'll call it the Lucky 4 partnership. Well, once again, we would be wise to sit down with an attorney and draw up this document called the buy-sell agreement, so that if one of us dies, we've got the money to buy out the heirs of the deceased partner, so that we're not forced to sell off our partnership to satisfy that claim, because they would have a claim against the partnership. So there are 2 ways we could skin this cat. One, we could have the partnership, the Lucky 4 partnership, buy one life insurance policy on each of us. That's referred to as an entity purchase buy-sell agreement. So the partnership would pay the premium and own the life insurance policy on each of us. And if one of us dies, that death benefit goes to the partnership that will be used to buy out the heirs of the deceased partner, because the partnership becomes the beneficiary of the policies it buys on each of us. The amount of the death benefit might be different on each of us, because we would have decided that when we negotiated the buy-sell agreement, depending upon the number of factors. How much money did I put in as opposed to how much money did you put in? That kind of stuff. Another way we could skin this cat is referred to as a cross-purchase buy-sell. And that's a situation where each of us would be buying a life insurance policy on the other 3. Cross-purchase, each partner buys a policy on the other partners. It ends up in the same place, but the methodology is different. So if one of us dies, the other 3 partners who own policies on that partner, those 3 policies would total the same amount that would have been there if the entity had purchased it. So the benefits will be available to buy out the heirs of the deceased partner. But each partner is the beneficiary of the policies they buy, and then we end up with cross-purchase. So cross-purchase, entity purchase. And really, in the real world, if we have more than 2 partners, rarely would we enter into a cross-purchase agreement, because it's very complicated. Could you imagine having 9 or 10 partners? So normally, if there's more than 2 partners, we'd use an entity purchase. So now, here's a typical question you may get. If there are 10 partners with a cross-purchase buy-sell agreement, how many policies will be purchased? Remember, you don't buy one on yourself. I'm going to give you the answer. It's 90. Multiply the number of partners by 1 fewer partner. That's the way it works. You may have figured it out. If you didn't, don't worry about it. This is it. It's not that difficult. In our case, there are 4 of us. That would be 12, because there would be 4 of us each buying 3 policies. So you multiply by 1 fewer partner. If you see this question on a test, you should jump on it. Don't worry about it. Just jump on it. They could be 100 partners. It doesn't matter. Just multiply by 99. You'll have a little calculator that'll be available to you to do these silly little math questions. It's either going to be a drop-down calculator on the computer screen, or it'll be some little calculator they got for the dollar store that you're going to have to beat the hell out of to get to work. But in any event, These are not complicated math questions, but if you don't understand what we're talking about, you get a little nervous. Okay. Key person, also referred to as key employee or key partner. So what is a key person? Well, a key person is a person, if the company loses that person, they will lose money. So the company has an insurable interest in them. That could take the form of a key partner or any key employee. They used to use the word key man. Well, um, um, political correctness now has forced us to go to key person, okay? So with a key person policy, the company owns the policy, the company pays the premium, and if the key person dies, the company gets the benefit so that they can have the dollars to replace that key person. The family of the key person doesn't get any money. Keep that in mind. The benefit goes to the corporation or the company they work for. Why would anybody do that? Well, there's a lot of reasons. Maybe a requirement. But I tell you what, if I'm that key person, you know what I'm going to tell the corporation I work for? That's fine. But I also want you to buy a policy that'll pay my family some money too. But that's a negotiation. But that's how key person works. Split dollar. Split dollar is not a kind of insurance. It's a way to pay for it. Where the employee and the employer split the premium. It could be 50-50, it could be 60-40, it could be any variation of percentages. Why would an employer do that? Well, because they may have a valued employee that they want to do something special for, and they don't have to do it for everybody. They can discriminate when it comes to split dollar. They can offer it to one employee and not another. So the employer, however, wants to protect themselves, and here's what happens. And these are the kind of facts you need to know with questions that may show up. Let me tell a little story. It'll be easier. Let's assume I own a company and I have an employee that is really valuable to me. If I want to do something very special to keep this person working for me, I want them to be feel valued and appreciated. So I'm out to lunch with him one day and we're having a discussion, and he looks at me in the eye and he said, I just bought some life insurance for my family, because I really need to do that. And I said, oh, that's great, man. It's a good idea. I'm proud of you. Protect your family. By the way, how much did you buy? Oh, 100,000. Okay. What's your premium? $100 a month. Okay. So I look at him and say, look, I want to make you an offer here. Supposing I come up with another $100 a month. That means you can get a $200,000 death benefit. Yeah, that'd be great. Well, I'll do that for you. I'll come up with $100 a month, and you now can have a $200,000 death benefit. And if you die, your family will get the $200,000, and I will be paying half of your premium. Wow, that's great, boss. What's the catch? Well, the catch is this. This is not a loan. This is not a gift. But I want my money back when you die. Or if you leave me, I want to be able to access the money I helped you in the premium I paid. So the best way I can explain it to you, folks, is this way. The employer is going to be able to place a lien on the cash value and death benefit of that policy equal to the premiums that they paid. That doesn't really affect the employee that much, because if the employee dies, all the employer is getting back is the premium they paid. The death benefit that it created is far greater than the premium. So the family of the employee is still far better off than they would have been if the employer did not do anything. So the concept here is they're splitting the cost so the employee can get more insurance that he could afford on his own, so to speak, and the employer is going to be able to recoup the premium they paid from the death benefit when the employee dies. But the beneficiary is the family. It's just that the insurance company is going to be instructed to peel off the premium that the employer paid before they pay out the death benefit, and then give that money back to the employer. And if the employee leaves the company, there's a lien on the cash value. So if the employee decides to cash out the policy, they can only get any cash that exceeds the employer's contribution. It's a protection for the employer. That's the catch. It's not a bad deal. Remember, the employee names the beneficiary, and the employer may never be the beneficiary, not on a split dollar plan. Let's talk about group life insurance. There are more than two types of group life insurance, but there are two major types they discuss on the test. The most common is employer-employee. With group life insurance, you got to have a minimum of 10 employees to have what's referred to as a true group or a natural group. With health insurance, it's 2. With life insurance, it's 10. But the rules are basically the same, other than the number of employees required. So the employer is referred to as the sponsor. The employer receives the master contract. They're the ones that have a contract with the insurance company to make sure that the premium gets paid and the proper number of employees are covered under the contract. They have to make sure they maintain that minimum number. Employees receive certificates that prove they're covered. Now, whenever a new employee comes on board, whether it's life or health, that new employee, I don't know if you've ever gone to work for a company that had group benefits, but usually they impose some kind of probationary period where you have to work for them for 30, 60, or 90 days before they will allow you to participate in the group goodies. That's called the employer-mandated probationary period. But once that probationary period is up, visualize, if you will, visualize a window opens and it stays open for 31 days. That's called an enrollment period. So that new employee has 31 days to enroll in the group plan, and they don't have to prove they're insurable. Now, group plans are also broken down and identified by who pays the premium. A contributory plan is identified by the fact that the employer and the employee is paying some of the premium. A non-contributory plan means the employer is paying all of the premium and the employee is paying none of the premium. So contributory, non-contributory is about who's paying the premium. Now, in addition to that, if it's a contributory plan, then the employer has got to get at least 75% of those eligible employees to participate in the plan. Now, if I have 10 employees, I don't know how I'm going to get 7.5 people, but 75% is the number. And with a non-contributory plan, the employer must cover 100% of the eligible group. Let's talk about that a little bit more. A non-contributory plan means what? The employer is paying everything. So let's assume I'm an employer and I got 50 people working for me in the warehouse and 50 people working in the office. I, as the employer, can decide I'm going to buy health insurance or life insurance for my office employees or my warehouse employees. I don't have to include everybody. I can select who's eligible. Now, I can discriminate based upon job classification. I can discriminate based upon how long you work for me, which is why I could have a probationary period, right? But I can't discriminate based upon age or gender, all right? So I say, all right, I'm going to cover 100, I'm going to cover my warehouse employees. So I have to cover 100% of them. That's my eligible group. Now, if it's a contributory plan, and I'm only going to cover my warehouse people, I've got to get 75% of my warehouse people to be willing to contribute their portion of the premium that the insurance company requires. I hope that makes sense. So contributory, non-contributory. On the test, if you get a question about contributory, look in the answer for the 75%. Or if you see a question about group insurance, 75%, look in the answer for the word contributory. And the same would be true for non-contributory, matching it up with 100%. That's the way it works. So contributory means the employee is paying some of the premium. Non-contributory means the employee is paying none of the premium. The other kind of a group plan that they talk about on the test is called an association group. Association groups must have a minimum of 100 members. They must be in existence at least 5 years, and they have to have a constitution, bylaws, and annual meetings. They don't want 10 cancer patients to get together to form a group. That must be a bona fide reason for this group to be together. So those are the rules with respect to group insurance. With group life, you got to have a minimum of 10. With group health, minimum of 2. All those other factors are exactly the same. And association groups, whether it's group life or group health, the same numbers apply. Now, what are some of the differences between group plans and individual plans? Well, with individual plans, the underwriting is a little more restrictive. They're looking at each individual that's going to be covered. So if we're buying a family plan, which is an individual plan, family plans are individual plans. So each individual must qualify medically for that policy. They will cover applicants and dependents, meaning their family members. And these policies are guaranteed renewable. We discussed that earlier. The underwriting is going to be based upon the ages and genders and health, current and past, of those potential insureds. They're going to look at occupation, moral and morale risk, look at some finance, make sure they can be paid for, look at their family history, health history. These are fairly restrictive underwriting processes. However, with group insurance, it's a lot less restrictive. Dependents are not always covered. If a person has a group plan at work and they want their dependents covered, they're going to have to pay extra for that. And they don't look at each individual person. They do what's called a census. They will take the insurance company will take into account the general health condition of the group. And when someone becomes eligible, they're automatically enrolled when they become eligible, as long as they're willing to pay whatever premium they're required to pay. So it's a lot less restrictive on group, which is one of the benefits of group insurance, as opposed to individual policies. And the premium, excuse me, and the premium, by the way, for group insurance compared to the same policy on an individual will be less. Group premiums are generally less than individual premium. Now, when somebody's a member of a group plan, they may leave that group. If they leave the group, they have the right to convert. They have the right to convert that policy to their own personal individual contract. And they've got 31 days to do it. This is true for life or health. They got a 31, it's called the conversion period. If they convert during the 31 days, they don't have to prove they're insurable. So if they have a group life plan at work, the group life plan at work, as a matter of fact, let me do this. Let me get to it. Let me find my, here we go. Bear with me here. The group life at work, usually 1 year term insurance. Sometimes it's referred to as annual renewable term. That's the most common type of group life insurance. 1 year term or annual renewable term. And the reason why that's the most common is that it's the least expensive, because the insurance company is only looking at the average age of the group, and they'll utilize what's called the unisex rate. So they blend the men and women rate together. And the average age of a group and the mix of men and women doesn't change much from year to year. Therefore, the premium on an annual renewable term stays a lot more consistent. It stays the same, so it doesn't go up very much. So it's the cheapest. So group at work is usually 1 year term insurance, but it automatically renews for a new year. Therefore, if a person wants to convert their group insurance at work, yeah, they can convert it without having to prove they're insurable, but they're going to have to convert it to a whole life insurance policy, or maybe a universal life policy, a cash value contract. They're not going to allow them to convert it to a term policy. Insurance company's not going to let them do that. So you may get a question on the test about someone who's converting their group life policy. What will it convert to? Well, the answer is going to be some form of cash value policy. Very often the answer is going to be whole life. Now, they're covered during the conversion period. So while they're trying to make up their mind over that 31 days, if they die during that 31 days, the group plan will pay the death benefit. But remember, sometime during that 31 days, they're going to have to come up with the premium. They have to pay the premium to keep the policy going after the conversion period is over. So any premium they're going to pay is going to provide them coverage, which begins from the end of the conversion period, from the 32nd day forward. And they're going to pay the premium not based upon the average age of the group, but now based upon their attained age, which is the age they are, and their gender. And they're paying individual rates, no longer group rates. And that's could be a deterrent because the premium can be high, especially if you're older. And with group health insurance, it's the same idea, except you're not getting life insurance. You're converting to an individual health plan, but you're still paying premium based upon your attained age and individual rates, and that could be expensive. So, fact, groups may not be formed for the sole purpose of buying insurance. That goes back to what I said about insurance companies don't want 10 cancer patients to get together to buy a group plan, because if you're a member of a group, you get it automatically. Well, that's called adverse selection. They're not anxious to do that. COBRA. You may or may not have heard of COBRA. COBRA is a federal law. I'm going to spell out what it means. It stands for Consolidated Omnibus Budget Reconciliation Act. It's a federal law. Consolidated Omnibus Budget Reconciliation Act. I told you I'm a terrible typist. Reconciliation Act. There we go. All right. That's what COBRA stands for. That's what those letters stand for. Consolidated Omnibus Budget Reconciliation Act. It's a federal law. So COBRA does not apply to life insurance. COBRA only applies to health insurance. COBRA is a federal law. Let me get to it. COBRA is a federal law, and here's what happens. Oops. COBRA is a federal law that says if someone has a group policy at work, that's group health insurance, and they separate from service, they have the right to, and this is the phrase you may see, extend the group coverage at group rates for up to 18 months. So COBRA is a federal law. It's not insurance. Federal is a COBRA law, is a federal law. It's not insurance. And the law basically says if someone separates from a group, I also should put in there, the group must be at least 20 employees. So if the group is at least 20 employees, COBRA says if you separate from that group, you have a right to extend your group coverage. In other words, stay on the group plan at group rates for up to 18 months. That's what happens with COBRA, at group rates for up to 18 months. That's COBRA. Okay. Taxes and retirement. Let's talk about taxes and retirement for life insurance. Remember, we discussed some of this earlier. The tax treatment of life insurance, cash values grow right, first in, first out. We talked about dividends being tax-free because they're refunds of an overcharge. Now, most of the time, the death benefit of a life insurance policy is income tax-free. But there are some exceptions, and we're going to talk about that in a few minutes. And premiums. The premiums we pay for life insurance usually are not deductible, not tax deductible. So we're going to talk about when might they be deductible. That would be beneficial to you for this test. So we're going to talk about that now. Life insurance premiums are tax deductible if the policy is owned by a charity. So if I own a life insurance policy and I'm paying my premium, I don't get to deduct that premium from my taxes. However, if I transfer ownership of that policy to a charity and I continue to pay the premium, then they treat that premium as if it's a donation to the charity, because now the charity owns the life insurance policy and they're going to make themselves the beneficiary, which is what I want, because I want my charity to benefit. So the premium I pay becomes a donation to the charity and therefore is tax deductible. Also, alimony. Alimony is tax deductible to the person who pays it, excuse me, and taxable to the person who receives it. And in many divorces, there is a life insurance policy. There are life insurance policies, and one of the litigants says, "I want that life insurance policy to stay in force, and you got to pay for it." And the other litigant says, "Well, yeah, but I'm already paying the alimony." "Yeah, well, I don't care." Well, here's what we're going to do then. I'm going to pay you the alimony, whatever it is, $3,000 a month. But if I pay the premium for the life insurance policy, we're going to consider that alimony as well. So that premium will be paid in lieu of alimony instead of alimony. Then it becomes tax deductible. So any premium that's paid in lieu of alimony becomes tax deductible. Or group insurance premium paid by an employer. So life insurance premiums are tax deductible in 3 circumstances. If the premium, think of it, charity, alimony, and group insurance by employer. That's the only time premiums are tax deductible. Now, when are death benefits taxable? Because by and large, death benefits are income tax free. Well, benefits are taxable when ownership transfers for value. So if I sell my life insurance policy, you may have seen this guy on TV, and you need cash now, J.G. Wentworth. The J.G. Wentworth is what's called, he's a viatical. They buy death benefits for less than the death benefit. They serve a valuable purpose. You see these ads on TV, where I sold my life insurance policy and now I can use the money to go to Hawaii. Fine, I don't need the life insurance policy anymore. My kids are all grown up. Fine, they sold the life insurance policy. Now, they transferred ownership of that policy to the new owner. The new owner is going to pay tax on the death benefit when the person who's insured dies. They're going to pay a death benefit, pay a tax that's based upon their gain. If they paid $50,000 for a $100,000 policy, they're going to pay tax on $50,000. So death benefit would be taxable when ownership transfers for value. Okay. We've already talked about modified endowment contract. I'm not going to review that again. Retirement plans. Retirement plans. There are 2 kinds of retirement plans, qualified and non-qualified. Qualified plans mean they qualify as a plan under the IRS rules. That's what that means. Non-qualified means they are not submitted to the IRS, and there are very few tax advantages. Qualified plans have tax advantages. So most qualified plans must be provided for employees only, and any premiums that are paid are tax deductible. They have to be formally written. There's a document that must be submitted to the IRS, and everybody knows what's in the document. There can be no discrimination among employees. They have to treat all employees equally. It must be a permanent plan. It must be there forever. They can't just give you a term insurance policy. And ultimately must be approved by the IRS. That's what we mean by a qualified plan. And qualified plans must have what's called a vesting requirement, where an employer sets up a plan and says, some of this money I'm putting in, because the employer can contribute to the plan, and the employer gets a tax deduction for the money they contribute to the plan. That's the employer's money. But a vesting requirement basically will say, after so many years, the employer contribution is now owned by the employee, and the employer cannot take it away. So the term we use is that the employee is vested in the employer's contribution. There's some mathematical processes they go through on how it could be a process of a certain percentage over time. There's a number of ways they do it. But the point you need to know is a qualified plan must have a vesting requirement, which means the employee ultimately will become 100% vested or own 100% of the employer money as well as their money, because you're always 100% vested in your money. It's how do you get invested in the employer's money, and that's done by what's called a vesting schedule. But with qualified plans, all withdrawals will be taxed because all deposits were tax deducted. There's only one exception to that, which isn't on your test. There's some new 401ks out there called Roth 401ks. We're not going to have those on our test. Non-qualified plans are different because the IRS is not involved. So now with a non-qualified plan, the employer can discriminate and choose one person or another. A split dollar plan is a non-qualified plan because that split dollar plan might be used by the employer to help the employee build more cash for when they retire. So the employee can have extra cash from their life insurance policy to enhance their retirement. So they don't have to provide that for everybody. They can discriminate. There's no tax deduction for the money that goes into these plans. Don't require any IRS approval. Sometimes we get tax deferred growth because some of these plans are annuities. Some of them are life insurance. But remember, any excess over cost is going to be taxed. That's that last in, first out rule. Any money you take out that exceeds cost, you're going to get taxed. Now, retirement plans, beyond what we just talked about, are broken down into defined benefit and defined contribution. A defined benefit plan is also referred to as a pension plan. Military personnel have pension plans where a person knows almost to the penny, based upon how long they've been in the military and how long they've been at the certain grade they're at, if they retire and eligible retire, how much they're going to get every month for as long as they live. That's a pension plan. It defined the benefit. If I'm an employer, and I have an employee and I say to my employee, look, I'm going to set up a pension plan and here's how it's going to work. If you work for me for 20 years, at the end of 20 years, I will provide you a benefit equal to 80% of your last year's income. I just defined the benefit. Now, a benefit plan or a pension plan, they're interchangeable, is a liability to my company. Because you see, because I made that promise, I got to fulfill it. So I'm going to have to find a mechanism to set aside money on a regular basis to make sure I can meet the promise that I just made that employee when the time comes for them to collect. And if I don't have the money to fulfill my promise, I'm going to have to take it out of current earnings of my company, which is why we're talking about it's a liability of the company. They may ask you about that. You don't find too many defined benefit plans in private sector anymore. Mostly pension plans are through the military or through government. And I'm just getting wind of the fact that military, a lot of them are now trying to get these young kids to get into 401ks, which really pisses me off. Anyway, defined contribution plans are where the IRS defines how much you can put in. There's no requirement that you have a certain amount of money at the end. It only is a requirement about how much you put in, defined contribution. One of those is referred to as HR 10, or also called KEO. Now, what does that mean? HR 10 stands for House Resolution 10. The year this thing passed, it was the 10th bill to go through the House of Representatives in Washington. KEO is the name of the congressman who came up with this idea. And he is memorialized, his name is memorialized as the name of the plan. It's called a KEO plan. So it doesn't have any special meaning other than what I just described to you. There are also what are called 401k plans. Many people are familiar with 401k plans. These are also referred to as salary reduction plans. We're going to talk about them in a minute. Then we also have what are called profit sharing plans, where companies can put money and share the profits of their employees and create a retirement plan for them to do it. Profit sharing. Then there's a special kind of plan called a tax sheltered annuity. TSA stands for tax sheltered annuity. They're also referred to as 403B plans. 403B. These letters and numbers, by the way, refer to certain sections of the IRS code. Section 401K of the IRS code spells out the rules that are followed. Section 403B of the IRS code spells out the rules that we need to follow. So they refer to them by the IRS code number. So 403B are like 401Ks, but only for special people, like school teachers and people who work for hospitals or nonprofit organizations. Then we have traditional and Roth IRAs. These are all defined contribution plans where the IRS makes a definition, defines how much can you put in. They limit your contribution, okay? So HR 10 or KEO. Here's the steps you need to know. We'll be breaking here in a couple of minutes. HR 10 or KEO are for self-employed people. Only self-employed people can have one of these. Or if you're a partner in a business and own at least 10% of that business, a partner owning 10% can participate in a KEO plan. The contributions are limited. There's a 59.5 rule. We discussed this when we discussed annuities, which means if you take any of the money from that plan before you're 59.5, Uncle Sam slaps you with a 10% premature withdrawal penalty on any of the gains you get when you withdraw. But it also has a 70.5 rule. There are not a lot of people that know what a 70.5 rule is. The 70.5 rule basically says, with these kinds of plans, you are required by law to take minimum required distributions. They refer to them as MRD, minimum required distributions, by the time you're 70.5. And if you do not take the minimum required distribution by the time you're 70.5, IRS is going to penalize you. And the penalty, I'm going to give it to you, is 50% of what you should have taken. If you don't take it, you're going to pay 50% on what you should have taken. Plus, you're going to have to add what you did not take to your income. That's a pretty severe penalty. So and there's a formula the IRS has. So if they look at my plan and they say, hey, based upon your age and your gender and the amount of money in that plan, you should have taken $30,000 this year, and you didn't, because you're 70.5 and you didn't do it. So we're going to penalize you $15,000, and you're going to have to add $30,000 to your income and pay tax on it. So that's a pretty serious penalty. No one ever, I shouldn't say no one, but I don't know anybody who misses this one, okay? Most of these plans will inform their plan holders that they have to do this. But there's a penalty, and you need to be aware of it. So the 70.5 rule is pretty severe. Don't worry about the 21,000 hours. 401k, we'll do that one first. 401k plans are also referred to as salary reduction plans. You may have been participating in a 401k along the line, where you have agreed to have a certain amount of money come out of your paycheck, and that money went into an investment account. You got a tax deduction for the money you used because it reduced your income immediately, and you paid tax on the lesser income. So those dollars that went into your retirement plan, that investment account, were pre-tax dollars. The company can match. Most companies do. There's usually a sliding scale as to how much they'll match, but they will often match. These plans are also referred to as CODA, C-O-D-A. And CODA is another acronym. It stands for cash or deferred arrangement. I'm going to paraphrase. So you're an employee of mine. Great. Here's your choice. We've got this little dealie over here called a 401k. You don't have to participate if you don't want to. You can keep the cash in your pocket, or you can participate in this deferred arrangement we call a 401k. Stupid, but CODA, C-O-D-A, cash or deferred arrangement. That's what it means. There are limits to how much you can put in, but you pay 100% tax on all the money you take out. Profit sharing. Profit sharing, you may get a test question about it, but I think, pretty straightforward, where the company has agreed to set aside money from profits to help enhance their employees' retirement. But the concept is very simple. No profit, no contribution, okay? If there's no profit, they don't have to put any money in. That's where the question may go. 403B, as I mentioned to you earlier, they're also referred to as tax sheltered annuities, TSA, tax sheltered annuities. These are also salary reduction plans, but these are only for people who are, I call them special people. The companies they work for can match. They don't often do that, hospitals and nonprofits, but they could. But these are for organizations like nonprofit, 501c3, another section of the IRS code that identifies nonprofit organizations. Public school employees participate in these. Those who work for churches, that's a 501c3 group, or hospitals like nurses and doctors can participate in these plans. Once again, there's participant contribution limits. IRA, once we finish with this section, we're going to take a break. IRA stands for Individual Retirement Account. How much can you put into an IRA? Everything you earn. 100% of everything you earn, you can put into an IRA, up to currently $5,500 a year. If you're 50 or over, make a note. If you're 50 or over, that number is $6,500, 6500. That's where it is currently. That can change in the future, but that's what it is currently. So how much? So if somebody works a job and they make $3,000 this year, how much can they put into the IRA? The whole $3,000. Okay. Now I don't know what they're going to live on, but they can do that. So everything you earn up to a limit, and the limit right now is $5,500 unless you're 50 or over. They have what's called a catch-up provision that allows you to put in an extra $1,000. There's also an opportunity if we have a spouse that doesn't work outside the home that's earning an income. They call it non-working spouse. They refer to it as a spousal IRA. Be real careful, when you're with couples, and don't accuse the spouse who's doesn't have a job of not working. She'll throw you out on your ear. Okay, I made that mistake early in life, and women get touchy, and I don't blame them because they work hard. If they stay home and take care of kids, that's still a job. They just don't have to get paid dollars for it. Okay. So they call them spousal IRAs, and they mean non-working spouse, meaning they don't earn an income. So the wage earner, may open a second IRA, an additional IRA, to put money in for their spouse who doesn't have a job that pays an income. So they can take whatever they earn and split it up between the two IRAs, no more than $5,500 in each. The money they put into the IRA is tax deductible. The money in the IRA grows tax deferred, but when your money comes out of the IRA, you pay 100% tax on all withdrawals. IRAs also have a penalty that says if you put in more than you're supposed to, then you're going to pay a penalty for an excess contribution. It's 6%. You see, if the feds wanted us to have money to retire on, why the heck do they limit us? But they do. And I have my own reasons as to why I think they do. I think they just want us to they want to have more control over us, okay? It's just the way it is. If they really wanted us to be independent and wealthy when we retire, they wouldn't put a limit on how much money we could put away for our future. Crazy. Anyway, but there is this excess contribution penalty. Be aware of it. Watch for it at 6%. Now, there's also that 59.5 penalty. If you touch the money before you're 59.5, 10% penalty. There are exceptions to that, however. You can grab money from your IRA without a penalty if you're totally disabled, or if you need up to 10 grand to buy your first house, or if you want to go to college, or if you have some catastrophic medical event, open heart surgery, or some major catastrophe. You can use the money to help pay for that with no penalty. Or if you die. But you notice I kept saying no penalty. You still got to pay tax. The tax has to be paid. The 59.5, 10% is a penalty. The penalty is waived for those 5 reasons, not the tax. Okay? And IRAs have that 70.5 rule as well. Roth IRA. Roth, named after a congressman named Roth. He's the guy that came up with the idea. So his name is memorialized in its title. So it's very similar to a traditional IRA, except there is no tax deduction for the money you put in, no tax deduction for your contributions. The contributions are still limited to the same dollar amounts in the traditional IRA, but the value of a Roth IRA is if the money grows tax-free. If you remember, in a traditional, it grows tax-deferred, which means ultimately you got to pay tax. Well, with the Roth IRA, the money grows tax-free. And any withdrawals are also tax-free. The caveat, however, is the account must be more than 5 years old to enable you to get money tax-free and have tax-free growth. It does have a 59.5 rule, so you still have to pay a penalty, but no tax if you touch the money before you're 59.5. And the no tax would only apply if the account is more than 5 years old. But there's no 70.5 rule because IRS isn't going to collect any money anyway, so they're not going to charge you a penalty. Now, a little aside, IRAs, whether they're Roth or traditional, you can use different vehicles as the vehicle to make the money grow. Like you see them advertised on TV. There are companies that want you to put your money in gold and silver or IRAs, and you can use savings accounts and CDs as IRAs. You can use annuities, which is a great tool in my opinion for IRAs. So these are vehicles, not IRAs are how the account is set up. What vehicle you use will be established as an IRA, either a CD or a bank account or annuity. Rollover. A rollover, a matter of fact, let's take a break before we get into rollover. Let's take a break. And so we're going to talk about rollovers. And the concept here is getting the right terminology for your test. The words that we use in our business sometimes are misused. That doesn't make it wrong. It just makes it difficult when we want to get the right answer on a test. So in the real world, rollovers mean what we've ultimately officially referred to as a transfer. So let's first talk about rollover and get this straight, because I'm as guilty as anybody. I have a tendency to use the words rollover when I really mean a transfer. So let's make sure you have it right for the test. A rollover, oops, I scooted along there a little bit. Let's go on. Back. Sorry about that. Okay, rollover. Let's assume we have an individual that has $100,000 in their current 401k, and they leave that job. That money becomes available to them. They can take that money and transfer it into a self-directed IRA if they choose. And many companies require it. Matter of fact, I have a client that I'm going to see this week who's got some money in a 401k at an employer that won't let them keep it there. They have to get rid of it. They have to take it. So we don't want to take it before you're 59.5 because there's a penalty. So we are offered the opportunity to move that money to what's called the self-directed IRA. So let's assume the person chooses to quote unquote roll over. So if they had $100,000 in their 401k, the law requires, if it's a rollover, that the current custodian, the financial institution that's holding on to the money, withhold 20% of that amount and send the account holder the difference. So the account holder is going to get a check for $80,000. The 20% withholding is sent to the IRS as like withholding from your checking account. And the only way you get that money is when you file your taxes next year. That's when you have access to it. So here's the challenge and the problem with rollovers. Once the account holder gets their check, they have 60 days to do anything they want with that money. But by the end of that 60 days, they need to open the new account to deposit the money. The rub, however, is any amount of money that they use to open that account that's less than the original 100,000 is going to be subject to a penalty, a premature withdrawal penalty of 10%. So what do we do? Well, IRS doesn't care. They say, look, you're short 20 grand. Borrow the money. I don't care. But if you don't open the account with the full 100,000, you're going to pay, in this case, a $2,000 penalty when you file your taxes. So we don't want to do rollovers, okay? It's just not a good thing. Besides, when the customer gets the money in their hand, but what generally happens is it filters through that hand and they end up spending it, which may put them even in worse shape, tax-wise, penalty-wise, and their future has been spent. Their retirement money has been spent. So it's not a good idea to do what's called a rollover. What we really do when we use the word rollover, what we really are doing is doing a transfer. So that's the proper terminology. A transfer is a direct institution-to-institution movement of funds where the custodian that has the money is instructed by the new custodian to send the money over. So we would open up an account. I use annuities a great deal for this. I have a few companies that I use that I think are excellent. So we'll open up an account with an annuity company. I have an annuity company that pays like a 10% bonus to get new money. So I will open an account with this company for my client. We will fill out some paperwork and send it to the custodian that's holding onto the funds and say, here's the account number. This is the account holder's name. Please wire the money over. And that becomes a direct institution-to-institution transfer. There's no constructive receipt of the money by the account holder. There's no withholding. Bing, bing, it's done. Nice and neat. So, and my particular account holder is going to get a 10% bonus when the money moves. It's pretty cool. So anyway, that's a transfer. So in the real world, a lot of us who are in our end of the business use the word rollover when we really should be using the word transfer. So on your test, I hope you can see now, there's a difference between a transfer and a rollover. Now, some institutions will not allow a transfer of funds. That's just the way they work. So they will allow, however, for this to be done by using what's called a direct rollover. Now, don't shoot me. I'm just a messenger. All these terminologies, right? A direct rollover. And a direct rollover occurs this way. Any money in the account, there's a check made out to the new custodian. So we would open up the account just like I just explained to you. And the financial institution, the custodian that's holding onto the money, will not do a wire transfer for whatever reason. So we have to submit them instructions to make out a check to the new custodian and send the check to the account holder. And they'll put on that check the account holder's name for the benefit of the account holder. They put FBO for the benefit of the account holder. So it'll be made out to the new custodian, ABC Insurance Company, for the benefit of Roger Smith. Okay, so the account holder now gets the money. They got a check in their hand, but they can't cash it because it's not made out to them. So once again, there's no withholding. And then they turn around and call me, and I have to go over and pick up the check and submit it to the new custodian. It's a pain in the neck. It delays the movement of the money. And the old custodian, my feeling is the old custodian is doing that because the longer that money stays in their pocket, they get to make money on it. So that's the difference. So we have rollover, transfer, direct rollover. That's the way we move money. Non-qualified plans, also referred to as deferred comp. Deferred compensation is a method where employers will set up a plan that they may open an annuity for an employee, a valued employee. They open up an annuity and put some money in the annuity that will be used for future use, where they will pay them, instead of giving them a raise, they'll put that extra money into the annuity so that at some time in the future, some deferred point in time, the employee now can access that money to help enhance their income stream when they retire. They're also called salary continuation plans. A lot of times we use what were called individual annuities. Okay. Split dollar arrangements are also considered to be a salary continuation plan. So you're not going to get questions about a lot of these, but understand non-qualified plans means what? No IRS mess, no IRS fooling around, but there's no tax deduction either. No tax benefits. Retirement. Most people, when they think of retirement, they think of the Social Security. And to get a Social Security check, you have to qualify. So to qualify for a Social Security check, you have to earn 40 quarters over a lifetime. That's not 40 25-cent pieces, right? That's 40 calendar quarters over a lifetime. So how much money you earn in a quarter is determined by Social Security Administration. The amount of money it takes to earn a quarter in 2017 is a lot more than it was in 1952. You're not going to need to know the number. If you want to know it, you can look it up, okay? But whatever that number is, you have to earn it in that quarter, and then, quote unquote, you have earned the quarter. Once you have earned 40 of them, then you can get a full retirement benefit at your full retirement age. And full retirement age is a moving target based upon your date of birth. My date of birth created a full retirement age of 65 and 2 months. Your date of birth is probably going to have a retirement age closer to 67. That target, that goalposts keep moving further and further out because they don't have the money. They're running out of money. So anyone can take a reduced benefit from Social Security starting at 62. So whenever somebody wants to, they can take less than their full retirement amount as early as 62. And for every year they delay from 62, they're going to get a little bigger check. But once they hit full retirement age, they're going to get their maximum check. And once they select whatever year, like at 62, if they took their money at 62, it doesn't go up every year. It only will go up if there is a cost of living increase. That check is locked in. There's also what are called survivor benefits. I think we might have talked about this, but we're going to go over it again. Blackout period. Blackout period. A surviving spouse doesn't get any money until they turn 60. From where? From their former deceased spouse work record. And the caregiver of minor children will get money. Any unmarried kids up to 18 will get money. Those are survivor benefits from the benefits that that deceased worker provided. We had a whole session on that. We also talked about accelerated death benefits. We're not going to talk about them again. So here we are, kind of at the end of this session. We're going to pick up another session in a second, but just want you to know that I kind of like this saying. It's one of the ones I have on the wall of my office because sometimes, especially in our business, it can get a little frustrating. You can go and it gets challenging because you get disappointed. So you just gotta stay positive. Just gotta stay positive. Just gotta stay positive. So now we're going to move into more specific stuff about health insurance. Health insurance. We've touched a lot on life. We've touched on health, but now we're going to drill down about health insurance more specifically. Once again, if you have challenges or questions as you're going through this material, please call me or text me or email me, trying to respect that 8 to 8 time frame that we talked about. Okay. So now we talked about life insurance replacement. There were some special steps we had to take. Well, there are special steps involved in the health insurance replacement. However, since the advent of the Affordable Care Act, the rules have changed. The test still seems to be stuck in the past, and the questions we get still seem to revolve around the fact that the Affordable Care Act doesn't even exist. There are very few questions that revolve around the Affordable Care Act. So we're going to approach this material as if the Affordable Care Act doesn't exist. We are going to try to school you a little bit about how the Affordable Care Act works in some instances, but by and large, we're going to stay away from the Affordable Care Act. Because before the Affordable Care Act was passed, if someone didn't like the health insurance policy they had, they could replace it if they were healthy enough, they could replace it anytime they wanted. With the Affordable Care Act, you can only do that at special points in time called enrollment periods, okay? Generally, I don't remember the exact dates. I think it's October through February of every year. You could do it. But prior to the Affordable Care Act, we could do it any time. So agents had to be very careful to make sure that if we replace one health insurance policy with another, just like in life insurance, we had to make sure the client was better served. The client had to be better off after we're done than before we started. And one of the challenges was the idea of pre-existing conditions. See, the Affordable Care Act has eliminated the idea that pre-existing conditions even exist. All insurance companies must cover everyone without regard to this thing called pre-existing conditions. But prior to that, pre-existing conditions were an issue. So one of the challenges we had to worry about was if we replaced the policy, a pre-existing condition that might have existed prior to the buying of the original policy might now be covered under that contract, but it won't be covered under a new contract. In addition to that, any new medical condition they may have acquired would be considered a pre-existing condition under the new contract. So pre-existing conditions are an issue, and you may get questions about pre-existing conditions. So there are some time frames. A pre-existing condition, I'm gonna type this out. Oops, wrong slide. A pre-existing condition is a condition a person has seen, should have seen, or been treated by a medical practitioner. Has seen, should have seen, or been treated or recommended to be treated. I'm not going to write that out, but it recommended to be treated by a medical practitioner within a certain period of time prior to applying for the contract. So how long an insurance company could look back in your health history to see if you had a pre-existing condition was determined by what kind of policy you bought. So if a person bought an individual policy, the insurance company could look back 2 years to see if there was a pre-existing condition. If they bought a group insurance policy, the insurance company could look back 1 year to see if there was a pre-existing condition. And if the policy was one of what's called Medicare supplement, these are senior policies, we'll talk about these later, Medicare supplement, or what are called long-term care policies, then the insurance company can only look back 6 months. So the length of time an insurance company could look back to see if there was a pre-existing condition was determined by what kind of policy was being applied for. You didn't know those time frames. They could look back 2 years to see if you had a pre-existing condition on an individual policy, 1 year with group, 6 months for long-term care and med sup. So now, if there was a pre-existing condition, what could the insurance company do? The insurance company had some choices. One, they could deny, not issue the policy. Two, they could issue the policy as applied. They could ignore it and just issue the policy. Or three, they could issue the policy with a temporary exclusion, meaning they weren't going to cover that condition for a short period of time. What would be that short period of time? Well, with individual policies, they could exclude that condition for up to, take a guess, 2 years. With group policies, they could exclude that condition for up to 1 year. And for med sup, I'm just going to abbreviate these, med sup or long-term care insurance policies, they could exclude for up to 6 months. So that would be a temporary exclusion that an insurance company could impose on that contract. The other option the insurance company had was to issue the policy with a permanent exclusion. A permanent exclusion, I mean they're never going to cover that provision. That is referred to, sometimes it's referred to on the test as an impairment rider. So when a policy was applied for, the insurance company used to have the opportunity to look back to see if there was a pre-existing condition. And those time frames, something you need to remember. If they found a pre-existing condition, the insurance company could pick one of these four options. And many times, not many times, but often, especially if somebody had like a bad back, insurance companies might issue the policy with a permanent exclusion saying, hey, Mr. Customer, you're healthy pretty much in every other way, but that bad back scares the dickens out of us. So we're going to issue your policy, but we're never going to pay any claims relative to any back issues. It's an impairment rider. And many times the customer would take that because, heck, they want insurance better half a loaf than none kind of idea. So that would be the issue with respect to pre-existing conditions. So 2 years, 1 year, and 6 months. Let's move into types of health insurance policies. Health insurance policies have gone through some major changes over the years. 1983, you don't need to know this number, but I'm throwing it out. 1983 was kind of a change year for health insurance, because in 1983, Congress passed a law that created what we now know as managed care plans, HMOs and PPOs. Prior to that, the only kind of health insurance that was available was called reimbursement policies. Reimbursement policies. Let's get into that. Reimbursement policy. So what's a reimbursement policy? Here's what happened. A person or a group plan at work would buy an insurance policy from an insurance company, and that person would be classified or actually called an insured. And if they got sick or hurt and wanted medical care, they could go to any doctor they chose. There was no such thing as a network. No such thing as networks. And when they went to the doctor, they would have the responsibility to pay the doctor. So the patient and the doctor had this relationship where the patient saw the doctor and the doctor took care of their medical needs, but the doctor expected the patient to pay. Well, if a person had this policy called reimbursement policy, we could say to the doctor, Doc, I really don't have all the money in my pocket right now, but I do have an insurance policy that will reimburse me. If you give me a bill, I'll send it to my insurance company and they will reimburse me your cost or most of the costs of this visit. And the doctor would say, okay, I'll do that, but I would feel a lot better if you would assign your benefits to me, where you would fill out the form, the claim form to the insurance company, and tell the insurance company to send me the money. So we would assign the benefits to the doctor. The idea here, the way health insurance used to be, the idea was that the doctor and the patient took care of your health needs, and your insurance company helped with the financing or the payment of those bills. So managed care plan has turned that totally upside down. We're going to talk about those in a minute. But I want you to understand, when we talk about the next few plans, these are what we used to call reimbursement plans, where you bought a policy, you were an insured, you paid premium to an insurance company, they made you a promise that if you went to any doctor, and as long as it was treatment that was covered under your plan, which was most of the stuff you needed. Then they would reimburse you when you sent them a bill. They would reimburse you, and then you would pay the doctor. Many times the doctor would want you to assign their benefits, which would make them feel better. But you had the ultimate responsibility to pay the doctor. The doctor and the insurance company had absolutely no relationship, which made it better, in my opinion, for the relationship with you and the doctor to get you better. Okay, that's reimbursement plans. With the advent of the managed care plans, that got turned totally upside down. And with managed care plans, now the doctors or the medical practitioners have a contract with an insurance company to get paid. So doctors are paid by the insurance company. And you now have to go to a doctor in a network. That network is an approved network of physicians that have agreed to receive payments from the insurance company. So now the insurance company's in the middle of this. And then the insurance company's helping make decisions about whether you're going to get care or not, or about whether you're going to get a treatment or not. You have to get approval. So there's a different mindset under those reimbursement policies as opposed to the managed care plans. So right now we're going to talk about those reimbursement policies. We refer to them as traditional plans today. We call them traditional. So traditional plans, there were basic plans, major medical plans, and then if somebody had basic and major medical, we would say they had comprehensive major medical. So there were three kinds of basic plans, major medical plans, and then if somebody had everything, we would say they would have comprehensive major medical. That's kind of how it worked. So now, let's start from the bottom. Basic plans. You have questions about basic plans. What are the attributes of basic plans that you may need to know? Well, basic plans are identified, number one, by the fact they have very low limits of coverage. Very low limits of coverage. You were lucky to get $10, $15, maybe $20,000 of coverage on a basic plan. Basic plans are also, I said there were three of them, basic hospital, basic surgical, and basic medical. So if I wanted to buy insurance because I was worried about paying hospital bills, I would buy a basic hospital policy. If I was worried about surgery, I would buy a basic surgical policy. And if I was worried about getting help and paying for going to the doctor or doctor visits, I'd buy a basic medical policy. So I could tailor what I bought based upon what my worries were, what my concerns were. So let's assume I buy a basic hospital policy, and I might have a $20,000 basic hospital policy. If I go to the hospital, it'll pay up to $20,000 worth of my hospital bill. But these basic policies are also identified by the fact that there were no deductibles, no coinsurance, and no copayments. These are called first dollar coverage. Now I'm going to assume, and I shouldn't, but I'm going to assume you have some idea about what a deductible is. A deductible is a dollar amount, kind of like in your auto insurance. You got to pay that before your insurance company will pay anything. So the higher your deductible, the lower your premium. That's the way it is in auto insurance. That's the way it was with basic policies. And if I could buy a policy, but with basic policy, no deductible. Coinsurance. What's coinsurance? Well, in health insurance, once we met our deductible, then the policy would break down at where the insurance company would pay some of the bill and we would pay some of the bill. That's called coinsurance, where the insurance company might pay 90% of the bill and we pay 10% of the bill, or 80-20 or 75-25. So once we meet the deductible, then we move into the phase referred to as coinsurance. And coinsurance is expressed in terms of a percentage. So the insurance company would pay the larger percentage of the bill and then we pay the smaller percentage of the bill. Basic policies have no coinsurance. Then we had copayments. Now, basic policies have no copays, but even in today's world of managed care, you go to see a doctor, you got to give him $15, $20, $25 just to get in and see them. It's kind of like your admission to get on the ride. That's a co-payment. So on your test, what I'm trying to do for you here is have you separate in your mind the difference among these three things. A deductible is the amount of money you got to pay before the insurance company's paying anything. A co-insurance amount is the amount you pay that you share in the bill once you meet your deductible. You share with the insurance company. The co-payment is a flat dollar amount you pay every time you see a medical practitioner. Now, basic plans have none of that. They're referred to as first dollar coverage plans. So once again, if I had a $20,000 basic hospital policy and I went into the hospital, that first $20,000 worth of bills were paid by my policy. I did not have to reach into my pocket to pay anything. However, if the bill exceeded 20 grand, now the hospital is looking to me to pay that bill. So if I were smart, I would have purchased a major medical policy to supplement the basic plan. So my major medical policy is identified by a couple of facts. Where basic plans have low limits, major medical policies have high limits. I've seen major medical policies with lifetime maximum limits of $1 million to $2 million. I mean, you got to be pretty dadgum sick to blow through $2 million worth of medical bills. It can happen, but would be rare. So I would have this major medical policy now that would supplement my basic policy. But before my major medical policy would kick in, I almost forgot. So my major medical policy now would cover hospital, surgical, and medical all in one contract. I didn't have to buy 3 major medical policies. So I would have basic, and if I was smart, I would have bought a major medical policy to supplement my basic contract. This policy does have deductibles, co-insurance, and co-payments, because now the insurance company has greater risk. They have a lifetime maximum benefit they have to be on the hook for, a couple of $1 million. So to help reduce my premium, they allow me to select the deductible. The higher my deductible, the lower my premium. Co-insurance amounts kick in, and the co-insurance ratios will affect my premium. A policy with a 90-10 co-insurance is going to have a higher premium than a comparable policy with a 75-25 co-insurance, because I'm only paying 10% of the bill on the 90-10, or I'm willing to pay 25% of the bill on the 75-25. And there were co-payments. With major medical policy, you have co-payments. Well, all those factors coming together establish this major medical policy. So now back to me. I went into the hospital, $20,000 basic hospital policy. I blew through the my basic plan, and now the hospital's looking to me, but I now say, but I have a supplemental major medical policy. But before that supplemental major medical policy is going to pay, I have to pay a deductible. That deductible has a special title. You need to watch for it on the test. It's called a corridor deductible. So supplemental major medical policies have corridor deductibles. You may get a test question. Which of the following policies has a corridor deductible? Answer, supplemental major medical. Because as I've been saying to you, that major medical policy supplements the basic. And if I had all of that you see on the screen, I would have comprehensive major medical. I could buy my basic hospital policy from company A. I could buy my basic surgical policy from company B, my basic medical policy from company C, and I could buy my major medical policy from company D. Doesn't matter. I could shop around and get my best pricing. But when I did that, by having all of that in hand, I have what's called comprehensive major medical, and the supplemental major medical supplements the basic. We had a lot more choices, and it made it a lot easier to be able to afford health care. Now, I'm not as bright as congressmen. I am not as bright as the members of Congress. But I have a feeling that they have totally forgotten how it was and how this system can be used to help reduce health care costs. This is off the topic, but my feeling is people are using health insurance incorrectly. They're like buying auto insurance and expecting the auto insurance to pay for their oil changes and pay for the tires when they wear out, when the tires wear out. No, you've got to assume some of the costs yourself. So now they're trying to build these HMO plans with high deductibles and trying to cover everything. Well, I may not want everything. I may not need everything. So companies used to have separate pools of risk, and they managed those pools very well. And premiums were not going crazy. And most health insurance was available through employers because it was reasonable, and employers could afford to help their employees with their medical bills by helping them buy their medical insurance. I don't know what I think most of our congressmen are just too damn young to even know what used to be. But who am I? I'm just assurance guy. I'm I'm not as smart as them. Just ask them; they'll tell you. But anyway, away from my little tirade here, I'll get off my soapbox. So hopefully you have some understanding now of how those traditional plans worked. Let's move to health maintenance, HMOs. The Health Maintenance Act, what they call the Health Maintenance Act of 1973, you don't need to know that, I'm just giving it to you. That was the law that created what we now know as HMOs, or managed care plans. So these managed care plans, they had great vision and great hopes that they would eliminate unnecessary medical visits by focusing on preventive care and by including as part of the plan annual physicals. You didn't have to pay extra for an annual physical. So the idea would be, and it sounds good, and it is good, that if they could catch diseases at an early stage, it would be less expensive to treat them. So the focus was on preventive care. But they require these HMOs to operate in specific geographic service areas, usually by zip code or city or county. And now when you purchase an HMO from an insurance company, they don't call us insureds. They refer to us as subscribers. So if you get a test question using the word subscriber, you're looking at the idea they must be talking about an HMO. So now as a subscriber, we're still going to pay premium, but it's referred to as premium into a prepaid health plan. You're prepaying your health insurance. You're putting money to the insurance company in case you need care later. And all that money is pooled together for what they call the common good. So it's a form of managed care. So now you're required to go to a doctor that's in a network. If you don't go to a doctor in the network that this HMO you belong to has, they're not going to cover you because the doctor has agreed to take certain payments. And if you want to go to a doctor outside the network, that doctor hasn't agreed to that. And the insurance company don't want to pay any more than they can negotiate. The most common type of HMO is called Independent Practice Association. IPA stands for Independent Practice Association. And here's how it works. The HMO would contract with independent physicians in some geographic area. They'd reach out to them and enter into a contract with them. And then when a member joins that HMO, they would choose their primary care physician from the physicians in that network. The test abbreviates primary care physician as PCP. Okay, now PCP here is not talking about a drug, right? It's talking about primary care physician. So the member chooses their primary care physician. And the benefit to the primary care physician as being part of the network is that they've negotiated a price from the insurance company that every month, whether you show up or not, that doctor's getting a check because you chose that doctor as your primary care physician. That check is referred to as a capitation fee. Think of it by the head. So for every person who selects the doctor as their primary care physician, that doctor receives a fee from the insurance company every month, referred to as a capitation fee. That's how they support themselves. That's how they pay their bills. That's how they send their kids to college. That's how they pay their staff. It's not done by the copay you show up with when you show up once every 4 months and give them $20. That doesn't cover much. So watch for the test. HMOs pay the physician a capitation fee. And so the primary care physician acts as a gatekeeper. If they think you need a specialist, they will refer you out to a specialist that's in the network. This is somewhat of a problem for some people because it restricts their ability to go to any doctor they want. But that helps keep costs down because all these doctors have negotiated and agreed to accept money from the insurance company. Now, these independent practice associations, you may see the question about open panel, closed panel. And the best way I can explain it to you is to put it into a narrative. So let's assume you are doctors. I'm making you all doctors. Poof, you're doctors. Okay? I'm an HMO. And I'm going to go to you guys because you happen to be practicing medicine in the geographic area that I operate as an HMO. And I'm going to come to each of you, and I'm going to make the same presentation to each of you. It's going to go something like this. Doctor, we have a lot of subscribers in this area, and we need some additional primary care physicians. We would love for you to join our network. We've checked you out. We think you're a fine doctor. You've got great credentials. So we want you to join our network. One of the questions you're going to ask me is, okay, Mr. HMO guy, how much you going to pay me? In other words, what's my capitation fee? And I tell you, you say, okay. Now you'll have another question. It'll go something like this. Okay, Mr. HMO guy, I have another question for you. I have a practice where I have a ton of patients that I see on a regular basis, and I do very well. I don't want to give up that practice. Will I be allowed to continue to see my current patients as long as I see your subscribers? If I say, yeah, doc, don't worry about that. You can continue to see your current patients. That's referred to as an open panel HMO. On the other hand, if I say, yeah, well, doc, that's a challenge you're going to have to deal with. If you join our network, you can only see our subscribers. That's called a closed panel HMO. So open panel, closed panel is really revolving around, can the doctor see outside patients or not? And as I said to you, as a subscriber to an HMO, you must stay in your network if you expect the HMO to help you pay your bill, unless it's an emergency. So if you're out of the area and you don't feel good and you want to go to a doctor, you're free to go, but they're not paying. Unless it's an emergency, then they'll pay. Let's move on to preferred provider organizations. This is a different form of managed care. Now, remember, with the HMO, the doctor was paid how? Fee for service. Was paid a capitation fee. PPOs are different. PPO, the physicians are not paid a capitation fee. They're only paid if they treat you. That's referred to as fee for service. This arrangement gives the member more choices because the network is a lot more broad. It's a bigger network. So now, as a member of this or a subscriber to this preferred provider organization, you can go to any doctor you want. But they will give you some, think of it this way, they're going to give you some books. And in those books are going to be the names and address of physicians. And if you go to a doctor in book A, your PPO might pay 90% of the bill and you'll pay 10. If you go to a doctor in book B, you may have to pay 20%. If you go to a doctor in book C, you might have to pay 25%. So depending upon what doctor you go to, you pay more of the bill. You may like one doctor more than the other, so you may go to a doctor that you like rather than a doctor based upon price. And as a matter of fact, if you go out of the network and go to any doctor you want, and for example, if you're in New York and you can't find a network doctor and you get sick and you feel like you want to see a doc, you can go. But you're going to have to pay perhaps half the bill, and they'll pay half the bill. So they manage their costs by managing how much they'll pay, but you still have more choices. So with a PPO, remember, with a PPO, remember, the PPO, the physicians are paid how? Fee for service. They don't get paid unless you show up. With an HMO, the physicians are paid capitation fee. They get a check every month whether you show up or not. You are more restricted in an HMO with respect to getting treatment because you must stay in your network unless it's an emergency. With a PPO, you have more choices, but more choices means you have more cost. Quick example, when we lived in California, my wife found this doctor up in Beverly Hills, and I lived in an area called Palos Verdes, and it was about 25 miles away, which in California is an hour and a half drive, okay? And she found this doctor. She loved the doc. He was a great guy, but he didn't take any insurance. So I had to pay half the bill. So every time she went up there, I paid half the bill. Well, that was the way. She liked that guy. So what am I going to do? Argue with her? Happy wife, happy life, right? So we understand you have more choices in a PPO than an HMO. The Blues. The Blues get questions. You get questions on the test about Blues. Who are the Blues? Blue Cross Blue Shield. You may be familiar with those companies. Blue Cross Blue Shield. Well, two questions you may get about Blue Cross Blue Shield is this. Blue Cross pays the hospital. Blue Shield pays the doctor. They're two separate entities, one paying the doctor, one paying the hospital. They combine them under Blue Cross Blue Shield. Think of it this way. I know when I was a young man, a lot of hospitals had crosses on the top. So the way to remember it, Blue Cross pays the hospital, Blue Shield pays the doctor. Just a trigger to help you remember the answer to that question. The Blues were also prepaid plans, much like HMOs. As a matter of fact, when Congress passed the Health Maintenance Act of 1973, they looked at the Blues and their operations, how they did things, and they structured HMOs much like how the Blues operate. Because the Blues were already prepaid plans where you, as a patient, joined that group and you saw members of that group and you went to doctors in the network. And you had to stay within your service area. So much like HMOs, Blues are a lot like HMOs. And the Blues, there's about 17, I think, different service area for the Blues. Anthem Blue Cross Blue Shield in most of Virginia is different than the Blue Cross Blue Shield up in New Jersey. It's called Empire Blue Cross Blue Shield in New York, New Jersey. So there's different service areas. You don't need to know that. I'm just trying to give you the visual. Now, one of the things that Blue Cross Blue Shield innovated was paying claims based upon the community you lived in, community rating. They also set up a system to pay claims based upon claims experience. And they use community rating for individual policies and experience rating for group plans. Here's where it's going to go if you see it on the test. Let's assume that I own a company that makes widgets. I got 10 employees and I have a group health plan from Blue Cross Blue Shield. And you also have a company that makes widgets. And you also have the exact same people as I have, same number of people, and you make widgets and you have a same policy from Blue Cross Blue Shield as well. You have a group plan. Well, each year, the insurance company is going to review the contract that we have with them. And they're going to annually review my contract and they're going to annually review your contract. And each contract could be subject to rate increases or not, depending upon the claims experience we've had. If I've got a bunch of sick people working for me and you got healthy people working for you, my experience is going to be a higher claims ratio than yours, so my premium could go up where yours might not. That's the way experience rating works. Community rating was for individual policies. And with individual policies, insurance companies cannot review those policies on an annual basis like they could with experience rating. They can increase premium, but only by class. We discussed this when we talked about guaranteed renewable. All individual policies in Virginia are quote unquote guaranteed renewable. Or what? They got to renew it. They can increase your premium, but only by class, right? As you move from one age bracket to the next, all plumbers, all insurance agents, men, women, that kind of stuff. Then we had, under managed care, we have what's called point of service plans. Point of service plans. It's a hybrid. It's a combination HMO PPO, where if a member has what's called a point of service plan, they can treat the plan as an HMO or as a PPO as best suits them. So example, if they're home in their geographic area and they need to see a doc, they would be best suited to go see a doctor, their primary care physician. But if they're out of the area and still need medical care, they can go to any doctor they want and they may have to pay a percentage of the bill, treat it like a PPO. That's the way it works. Medical savings accounts. Medical savings accounts are set up by employers to help employees pay for medical expenses that are not covered in the policy. Medical savings accounts. These are employer funded. The employer puts money in this account for the express purpose of helping employees pay, as I said, for medical expenses not covered under the group plan. It's only for small employers. You need to make a note. It's only for small employers. So we've just defined what a small employer is. Any employer that has between 2 and 50 employees can have a medical savings account. If we have more than 50 employees, you can't have a medical savings account. Why did I start at 2? Because in health insurance, to have a true group, you got to have at least 2 people. So only small employers can have a medical savings account. So let me give you a little narrative of how this would come about. I'm an employer. I have group insurance for my people. I've got 30 employees working for me. But my premium keeps going up. And the only way I can reduce my premium is to increase my deductible. So if I go out and buy a high deductible health plan, I can save money in premium. So if I do that, what I'm going to probably do, if I'm smart, I'm going to open a medical savings account and take the savings that I get by having the higher deductible plan, and I'm going to deposit those savings into this medical savings account. So I buy a high deductible health plan, the premium dollars I save go into the medical savings account, and then the employee can use those dollars again to pay for medical expenses not covered in the policy. It's a pretty straightforward thing, okay? Now, one of the questions you may get is, if the employee leaves the employer, do they get to take any of that medical savings account with them? Answer, no. It's not their money. They didn't put any money in. It's the employer money. So if they leave, the money stays with the employer because it's the employer's money. Also, the idea here is that account can grow from year to year because any money left in that account will continue to be funded in the future. So that creates a nice pool of funds to help employees pay for things not paid for by the policy, which might help them meet their deductibles, might help them pay for dental and vision costs, a lot of reasons why it might be beneficial. Now, ignore the 65 thing here. Ignore that. It's not on the test. I should get rid of it. Now, there's another kind of account called flexible spending account. Some of you may have had experience with a flexible spending account. Some employers make these available. These are a way for employees to set aside money pre-tax to help pay their medical bills. So the employee will elect to reduce their salary by a certain amount of money and then have that money deposited into this thing we call a flexible spending account. The employee benefits because it reduces their pay by that amount and they pay tax on the lower dollar, much like a 401k does, because those deposits are exempt from taxes. However, with a flexible spending account, watch this, it's a use it or lose it account. If you don't use the money up by the end of the company's fiscal year, you lose your money. So what happens usually around October and November of every year, the people who have FSAs are running around buying eyeglasses and contact lenses, whatever they get their hands on, and legitimately so that they don't lose their money. Use it or lose it. Also, once an employee agrees to have a certain amount of money come out of their check, they may not make any change just because they feel like it. They have to wait until their hire date anniversary, or if the company they work for says, okay, in June, we're going to have an open enrollment period and anybody can make any changes they want to their medical savings, to their flexible spending account if they choose to. Or, or one more thing I want you to have, and I don't have it on my slide, I don't know why. If a life-changing event occurs, if a life-changing event occurs. So if there's a birth of a child or a death or a marriage, that's a life-changing event. They're all, I know you know, life-changing event. If should that occur, then the employee would have the opportunity to make a change to that amount they're putting into their flexible spending account. So what are the reasons why someone could make changes to their contribution to their flexible spending account? Anniversary date, open enrollment period, or life-changing event. We have another kind of account. It's called a health reimbursement account. These health reimbursement accounts, there is no insurance policy. This is where an employer funds an account sufficient to be able to reimburse employees for qualified medical expenses. It is treated like a health account. It's treated like a health insurance policy because the employer can deduct the cost of the funds they place in the HRA just like they could deduct the premium they pay for a group health plan. And if the employee uses any of that money, they don't have to pay taxes on it because these are health expenses, not buying beer expenses, okay? So there's no tax consequence for the employee to utilize a health reimbursement account. Once again, the balances roll over from year to year. Any size employer can have a health reimbursement account. Remember, medical savings accounts, small employers, health reimbursement account, any size. Here's the way I remember it. And I have some tricks I play in my brain. It just helps me. Medical savings account. I look at the letter M. I think of mini. I think of small. I use that relationship. So small employers have medical savings accounts. Any size employer can have health reimbursement account. That may or may not help you, but that's what I do. Yeah, however, you generally won't find some mom and pop grocery store having a health reimbursement account. They just don't have the funds to fund it. But anyway, that's how they work. Once again, the money's the employer. So if the employee leaves, they don't get to take it with them, just like in the medical savings account. Health savings accounts. These are awesome. I'm a big fan of health savings accounts. As a matter of fact, I got a feeling that part of this change that may come about ultimately with all the discussion in D.C. about the Affordable Care Act is they may re-promote health savings accounts. Health savings accounts are out there and they're awesome. A health savings account is an account, anybody can have one, where you can set aside money into this account with tax advantages. But it must be linked to a high deductible health plan. So not all health insurance policies can have a health savings account attached to them. Must be specifically designed. You don't need to worry about that. You do need to watch for the letters HDHP. So any HSA must be linked to a high deductible health plan. The value here is, of course, when we have health insurance, we can deduct the premium for that health insurance from our taxes. It's a limited deduction, but we can take it. We'll be talking about that later. But your premiums for your health insurance are tax deductible. That's not an innovation. But here's the innovation with an HSA. The money you put into your health savings account is tax deductible. You can take that off of your taxes. Helps reduce your tax. And then the interest you earn on that savings account is earned tax-free. And there are no taxes or penalties as long as you use that money for qualified medical expenses. This is an incentive for people to save money for their health insurance needs. I'll give you a quick example, true story. I have a customer here in, a client in Williamsburg, and when I met him, he was in his early 60s. His wife was just a little younger, and I'm sorry, early 50s. His wife was a little younger, and they were paying like $900 a month for their health insurance. This is before the Affordable Care Act. They were paying $900 a month for their health insurance. Even with the Affordable Care Act, they wouldn't have qualified for any subsidy. They were making too much money. So he was complaining about his premium, and I said, well, I've got an idea. I explained the health savings account to him. I said, the higher your deductible, the lower your premium. I made it very simple. He said, great. How high a deductible can I have? I said, well, I got a policy that'll provide you a $10,000 deductible. $10,000 deductible. He said, really? I said, yeah. He said, what would my premium be? I said, well, the premium would probably drop to about $300 a month. Really? I'm going to save $600 a month in premium? Yeah. He said, great. Let me have it. So here's what happens. He bought the policy. His premium's now $300 a month, but he's got a $10,000 deductible. but he takes the $600 in savings and he drops it into the savings account. Yeah. In 10 months, he's got $7,200 in there. He's close to his deductible. And if he needs help during the year, they give him a little debit card and he can run to the doctor and he can use the money in the savings account to pay for his doctor bills. So it's a lot cheaper for him in the long run, isn't it? Health savings accounts are awesome. So these are the bullet points you need to know about health savings accounts. Now, we're going to discuss disability income insurance. And disability income insurance is different than medical insurance. Medical insurance pays medical bills because you're sick or hurt. Disability income insurance replaces earned income. So if you visualize, we have an umbrella called health insurance, and under that umbrella, one side says medical expense, and the other side says disability income. So now we're going to talk about disability income insurance. So disability income insurance is designed to replace earned income. Earned income, like you show up at a job and earn money. If you can't show up, if you're disabled, the policy will help you. It doesn't pay if you are disabled and all your money is coming from investments, because that's not earned in the sense that what they're talking about here. So these policies are structured in such a way that the insured, can select what's called a benefit amount. How much a month will they get if they get disabled? There's a benefit period. How long, once they get disabled, will they receive a benefit? It could be 6 months, 9 months, a year, could be lifetime. The longer the benefit period, the higher the premium. Then there's an elimination period. So an elimination period in a disability income policy functions just like a deductible in your auto or health policy. So an elimination period, however, is not dollars, it's measured in time. The longer the elimination period, the lower your premium. So an elimination period is a period of time once you get disabled that you must eliminate or wait before your policy will provide you any benefits. These can be sold to groups or individuals. So let's talk about the benefit amount first. Disability income insurance policies will not allow you to buy any benefit amount you want. It's limited to be no more than 60 to 70% of your earned income. They don't want somebody to buy a disability income policy that'll pay them $6,000 a month if they're making $500, then they blow their foot off so they can get $6,000 a month. Not going to do that. It's no more than 60 to 70% of earned income. Elimination period, as I said, it works like a deductible. The longer, the lower the premium. So no benefits are paid until the elimination period is satisfied. And the insured gets to choose what they like. So it's a time deductible rather than a dollar deductible. And then the benefit period, the longer your benefit period, obviously the higher your premium, and that's the length of time benefits are paid once the elimination period is satisfied. So that's the basic structure of a disability income policy. So let's drill down a little bit. You may get a test question about a short-term disability contract. What qualifies as a short-term disability contract? Any disability policy that has a benefit period of a year or less is called a short-term disability contract. Any disability contract that has a benefit period of 2 years or longer is going to be called a long-term disability contract. So it's just a line in the sand that somebody drew. You just need to be aware. So if it's a benefit period of a year or less, it's short-term. Benefit period of 2 years or longer, it's long-term. That's just what you need to know. Injury. We can become disabled because we got sick or because we got injured. Now, different insurance companies will use one of two definitions, different definitions to define a qualified injury. Some insurance companies will use a very nice or unrestricted definition called accidental bodily injury. If you become disabled as a result of an accidental bodily injury, we'll pay you a benefit. Other companies use a more restrictive definition, meaning will only pay you a benefit if you have an accidental bodily injury caused by accidental means.
I have a quick question. This goes back to the health insurance replacement. When you went over the med supplement, you also said the LTCI part.
Yes. Yes.
What does that mean? What does it stand for?
Oh, LTCI?
Yes.
Long-term care insurance.
Long-term care insurance.
Yes. And we have some.
Thank you.
Oh, that's all right. No problem. And we have some slides that'll be coming up that we're going to drill down and talk about long-term care insurance to give you more information. But that's a great question. I'm glad you asked. That's what we're here for. Okay, good. Great, great. Okay, so now back to where we are. We're talking about disability income. So now let's assume that my disability income policy uses the accidental means definition. And I'm going to change a light bulb on my porch. So I climb up a ladder, I change the bulb. On the way down, I'm in a hurry, so I jump from the third rung and I break my ankle. There's no question the ankle break was an accident, but my policy is not going to pay me a benefit because I jumped. The cause of the accidental break was not an accident. If the rung of the ladder breaks and I break my ankle, now I have accidental bodily injury caused by accidental means. So that's a much more restrictive definition. I think you can see that. A way to remember it, means is meaner, huh? Means is meaner. You may be asked a question, which of these two is more or less restrictive? Also, the accidental bodily injury by accidental means definition, all other things being equal, will have a lower premium than the accidental bodily injury definition. Why? Because the insurance company has a greater exposure under the accidental bodily injury definition. Okay, so understand how that works. We already talked about presumptive disability earlier yesterday. This comes up in disability questions and in the world of disability income insurance. So the total and irrecoverable loss of sight, hearing, speech, or the loss or loss of use of any two limbs, we already went through that. That's classified as a what? Presumptive disability. And if you think back, what does that mean? Well, that means the insurance company presumes that disability is total and permanent, where normally a typical disability, they can make you go to a doctor once in a while to see if your disability is continuing. And if they find out you're no longer disabled, they're going to stop paying you and make you go back to work. But if a person is classified as presumptively disabled, it's considered to be total and permanent. Total and permanent. Now, with a presumptive disability, the policy's got to pay out the full amount. The full amount. We talked about that. Where a policy, we had that. We were talking about AD&D. Let's just do a quick review of that. We were talking about accidental death and dismemberment policy, where the accidental death and dismemberment policy would pay out $10,000 if somebody died by accident. But if somebody got dismembered, it might pay less than that, maybe $2,500. And they would call the $10,000 the principal sum and the partial amount the capital sum. But if somebody loses two limbs, then they would receive the full $10,000 because it would be a presumptive disability. They're going to pay out the full amount. There's another question that may show up on the test about presumptive disability. Here's the way it may work. Let's assume someone has a disability income policy that's going to pay them $5,000 a month for a year. Well, $5,000 a month times 12 months, that's $60,000. If they have a typical disability where they just totally disabled, they're in a body cast, okay, that's total but not necessarily permanent, right? Well, they're going to get, after the elimination period, $5,000 a month for up to 12 months. But if they lose two or more limbs, the insurance company's not going to give them $5,000 a month for 12 months. They're going to cut him a check for 60 grand. They're going to give him the full amount. Why? Because he is presumptively disabled. He's going to get the full amount. I hope that makes sense to you. So now, so presumptive disability, there's your definition. And as I said yesterday, just as a reminder, digits, toes, and fingers are not limbs. So if somebody loses 2 or 3 fingers, no benefit, okay? It's not presumptive if they lose 2 or 3 fingers. It must be a limb, okay? Recurrent disability. Recurrent. Now, this is not a kind of disability the way we define presumptive. It's more trying to explain to us what will the insurance company do if a person becomes disabled and then gets better, goes back to work, and then has a relapse. So if you see a question about recurrent, I want you to think of reoccur or relapse. And here's how it works. Let's assume that somebody's making $5,000 a month and they buy a disability income policy, 60% of that benefit, $3,000. They selected a 30-day elimination period and a 5-year benefit period. That's our premise. And let's assume our individuals had a heart attack, out for a year. Well, that person has collected 11 months benefits because of the 30-day elimination period. Out for a year, they collected 11 months benefits. They got $3,000 a month for 11 months. But let's assume the year is up, they go back to work, and within 6 months, that's the operative, within 6 months, they have a similar or related event, another heart attack or a stroke. The insurance company is going to treat that as a reoccurrence or a relapse of the original disability. So they're going to continue the benefit as if they never went back to work. Good news and bad news. The good news is they don't have to go through the elimination period again. But on the other side of the coin, they've used up 11 of the 60 months, so they have 49 months left. That's the way this works. If it's more than 6 months after they go back to work, even if it is similar related, the insurance company is going to treat it as a new disability and everything gets reset. New elimination period, new benefit period. So the idea of recurrent, relapse, reoccurring, all mean the same thing, huh? I hope that makes sense to you. Probationary period. Probationary period. This word gets thrown around and people can get confused because we use it for a lot of different things. If you go to work for a company, you have to work from a certain period of time before you become eligible for benefits. That's a company-imposed probationary period. This
Quick.
Go ahead.
I'm sorry again. Can you please go back to the last slide? We were writing down the returns to work part.
Oh, you don't have that slide?
No, we don't.
We have it, but we don't have the
We just have the how many months
benefit has he collected.
Yeah, we just have that part. We don't have the returns to work.
Oh, I apologize. I'm sorry about that. Okay, no, that's great. I'm glad you told me. No, that's. Let me know when you're ready.
All right, thank you.
Great. Okay, so probationary period. Probationary period, as I started to say, if you go to work for a company, they're going to make you work for them a certain period of time before you become eligible for benefits. That's not what we're talking about here. This is a probationary period imposed on disability income policies for disabilities caused by sickness, So I want you to think of it this way. If I buy a disability income policy, there's really generally no medical exam done, so they have no idea what my medical condition is other than what a doctor may tell them when they ask for my medical records. But if I have gone somewhere to a different doctor and didn't tell them, and I'm finding out that I'm going to come down with some debilitating disease that's going to make me disabled, I might try to get over on the insurance company by buying this disability income policy and then start collecting benefits. Well, that's called adverse selection. That's not cool. Okay, that's not what insurance companies do. It's like buying auto insurance after you get into a wreck. Okay, so insurance companies have to protect themselves by imposing a probationary period for sickness. It's only one time, only at the beginning of the contract, and it runs for 30 days. So there's a 30-day probationary period on all disability income policies that will apply to any disabilities caused by sickness. This is different than the elimination period. See, elimination period, you must satisfy an elimination period every time you get disabled. Every time a new disability begins, you have to go through a new elimination period. But the probationary period is only once, only at the beginning. You're kind of on probation for any disabilities caused by sickness. So if you get disabled by any disabilities caused by sickness in the first 30 days of that contract, they're not paying. That's how they protect themselves. It doesn't apply to injuries. You get disabled by injury, you're covered. You may have to go through your elimination period, obviously, but you don't have to worry about not having coverage. And the purpose here is what? To reduce adverse selection. Now, just like in life insurance, we have business uses of health insurance. And one of the business uses of health insurance is what's called business overhead expense insurance. It's a disability income policy that will provide that if a business owner becomes disabled and can no longer generate income for their business, this policy will help pay their overhead expenses. Now, this tax deductible stuff in health insurance, I'm going to go through it. I'm going to post it on the screen, but I'm going to go through the tax deduction issues on health insurance in one session, do it all at once, because I found that after I put all this together, by giving it to you piecemeal, it just gets more confusing, and it's confusing enough. So I'm just going to tell you, the premium for business overhead expense insurance is tax deductible, but the income is taxable to the business. But we're going to cover that in more detail later. When we have disability buy-sell insurance, works much like that disability life insurance, that life insurance buy-sell we talked about. But in this particular scenario, we're worrying about what happens if one of us gets disabled instead of one of us dying. And now the premium is not tax deductible, the benefit's tax-free. I'm going to cover all of that in one fell swoop. And then we have key person disability insurance, just like we had key person life insurance. Okay, so the tax issues, I'm just going to ignore it for now. We'll cover it all in one fell swoop. Let's get into the actual product. BOE, business overhead expense, not the benevolent order of Elks, okay? BOE. So here's what happens. It's only for small businesses. Now, ladies and gentlemen, please be careful. Do not confuse small business with small employer. We define small employer as an employer that has between 2 and 50 employees. That's not what they're addressing here. A small business, kind of like this. Let's assume I'm a landscaper and I have a small office and I have a person that comes in a couple times a month to help me with my billing. And I have to pay them. I have to pay my rent. And I have I borrowed money from the bank to buy some equipment. I have to pay those bills. And if I don't cut grass, there's no money to pay those things. So this is insurance that I would buy to pay those overhead expenses. A small business is defined as a business where the business owner is the main generator of income, okay? So it's only for small businesses. A company like New York Life would not qualify for this. So again, we're going to talk about the taxes later. But here's the deal. If the owner becomes disabled, the policy will pay rent, phones, utilities, even employee salaries, but it does not pay the employer's salary. Doesn't pay the employer's salary. If the employer wants to be able to be compensated should they become disabled, they have to buy a separate individual disability income policy because the employer's salary is not considered an overhead expense. So understand how that works. Disability buy-sell. Just like life insurance buy-sell. Again, ignore the tax issues. We're going to cover them in one place. So just like with life insurance, if we have a partnership, we could choose to have buy insurance that will help us buy out a disabled partner should a disabled partner become should a partner become disabled. Because you see, business is business and friends are friends. And if a partner becomes disabled, after a period of time, how long are we going to allow that partner to participate in the goodies and the profits of a business when they can't participate in it. So we want to utilize this disability buy-sell contract to help us buy them out. So just like in life insurance, we could use an entity purchase where the partnership pays the premium, the benefits will buy out the disabled partner. They have long elimination periods where the partnership buys the policy on each of us. If one of us gets disabled, the policy pays to the partnership, the entity, and it's a lump sum payout. There's not monthly payout. So if I get disabled, let's assume we have this deal, and I become disabled, and we've decided we're going to have a 1-year elimination period in our contract. Once a year is up, the contract's going to execute, and the partnership's going to get the money, and I'm going to get paid, and I'm out of here, okay? We can also do cross-purchase. It's the same deal. Each partner buys a policy on the other partners. The benefits buy out the disabled partner, 1 to 2 year elimination periods, and it's a lump sum payout. So it's the same mechanism, except we're using disability insurance to buy out a disabled partner as opposed to life insurance to buy out the heirs of a deceased partner. So now, understand now we're talking about disability income insurance as opposed to life insurance. So we have these elimination periods and lump sum buyouts. Elimination period and lump sum buyouts. So what I'm going to do at this point, what I want to do, let me see where we are. Oh yeah, let's do key person disability. And then I want to take a break and we'll come back and talk about taxes. Key person disability income insurance. This is much like key person life insurance, where the company pays the premium, company owns the policy. If the key person gets disabled, the company gets the benefit. Why? Because the loss of that key person caused a financial hardship to the company, and the company now has the money to replace them. Of course, you can't do it again without their written permission. Need their signature. We'll get into AD&D after we get back. Let's take a break. I'll record it. There you go. We got it started.
Cool. Thank you.
All right, no problem. All right, so now, tax issues. There are some questions about taxes, and it can be a little confusing. And you don't need to become a tax expert, but you do need to have a handle on some of this. You at least want to get some of them right. So medical expense insurance, the tax issues are different than the tax issues with disability income insurance. So I'm going to take a moment here to take them on one at a time. We're going to first start with medical expense. Medical expense insurance includes major medical policies, long-term care insurance policies, med-sup policies, any policy that helps pay a medical bill, okay? And here's the way it works. Premium, and the questions revolve around premiums and benefits. Are the premiums tax deductible or not? And are the benefits taxable or not? So we're going to start with premium. With medical expense insurance, premium is always tax deductible, meaning the person who pays the premium gets to deduct some or all of that from their income tax. The question becomes, how much of that premium is tax deductible? So here's the way it breaks down. An employer, anyone who is self-employed, gets to deduct 100% of the premium they pay for any health insurance. So if an employer pays any premium towards health insurance for their employees, they get to deduct 100% of that from their income. Anyone who's self-employed gets to deduct 100% of the premium they pay from their income. However, any employee, which means anyone who's not self-employed or an employer, they can only deduct the amount that exceeds 10% of their what's called AGI. That stands for ADJ, adjusted gross income. You don't need to figure it out. You're not going to be asked to figure it out, but you do need to recognize it. So an employee can only deduct, as a medical expense deduction, the amount that they pay that exceeds 10% of their AGI. So let me give you an example. Let's assume that somebody's adjusted gross income is $100,000. That means they would have to have medical expenses, which would include premium that they pay, plus, sorry about that, plus, what's going on here? I can't get it right. I told you I'm a terrible typist. Plus any unreimbursed so that would mean any premium they pay plus any unreimbursed out-of-pocket expenses must exceed $10,000. I'm sorry, $10,000. So if everything they spend between premium and out-of-pocket medical expenses comes out to $10,001, they get to deduct $1. Senior citizens, those people who are 65 and older, that 10% moves down to 7.5%. 7.5%. So you'll need to know those numbers. You may see that on a test. So the premium that's paid for medical expense insurance is always tax deductible, no matter who pays it. The question becomes how much of that premium is tax deductible. So an employer gets to deduct 100% of everything they pay towards their employees' health insurance. Anyone who's self-employed gets to also deduct 100% of the premium they pay for their health insurance. But anyone who would be called an employee only gets to deduct the amount that exceeds 10% of their adjusted gross income. And that's the example I made you. And then senior citizens, that 10% threshold drops down to 7.5%. Now let's talk about disability income insurance. Oh, talk about the benefits. So the benefits from a medical expense policy are always income tax free. You never have to pay tax on any benefits you get from any health insurance policy, ever. I mean, any medical expense policy, ever. If somebody has a cancer policy and they get paid $5,000 because they got diagnosed with internal cancer, that's tax free. They don't have to pay taxes on that. But the premium they paid for that policy, they can get a tax deduction for it if they meet the criteria we just laid out. Now let's move to disability income insurance. Disability income insurance is a little more convoluted. We'll start with premium first. Premium is tax deductible to an employer, and they get to deduct 100% of the premium they pay, just like regular medical expense insurance. So premium is tax deductible to the employer, okay? But we had other slides that come up and talked about business overhead expense insurance and buy-sell agreement with disability income insurance. So that's where it gets confusing because all of those tax deduction things came up and I said, hold off, we're going to get to it now. So here's a rule of thumb I want to pay you. Other than an employer paying premium for their employee, the rules are different. And I'm going to use some phrasing that is, I'm trying to be as general as I can. When the payer is different than the receiver, the rules change. When the payer is different than the receiver, then the premium the payer pays is tax deductible. And that refers back to The employer. See, the employer is paying premium for a policy of disability income insurance for their employee. So the payer and the receiver, if the employee becomes disabled, the employee is going to get the money, right? So the payer and the receiver are different. Therefore, the premium is tax deductible to the payer. However, when the payer is different than the receiver, if the receiver becomes disabled, the receiver is taxed on the income. So when somebody else is paying the premium, I can't believe I spelled it wrong. When someone else is paying the premium and you get a benefit, then it's taxed. So for example, if your employer has a disability income policy that they're paying premium for, that if you get disabled, you get a benefit, they're going to get a tax deduction. But you're going to have to pay taxes on that as income. Now, if you pay the premium, if the payer and receiver are the same, then there is no tax deduction for the premium paid. No tax deduction for the premium paid, and the benefit is tax-free. So there's this relationship here between who's paying and who's getting, okay? So back to the employer. If the employer is paying premium for an employee's health insurance, disability income insurance, then the employer gets a tax deduction. But when the receiver, who's an employee, gets the benefit, then they have to pay tax. So the receiver is taxed on the income when the payer and the receiver are different. When the payer and the receiver are the same, the payer gets no tax deduction, but their benefit's tax-free. So if you go out and buy your own disability income policy, you pay the premium, you don't get a tax deduction for that. But should you become disabled, the benefit you get is tax-free. So let's go back to those slides that we slipped through so quickly. Business overhead expense insurance. The owner pays, but the business gets. If the owner becomes disabled, the business gets the benefit. So the payer, who's the owner, and the receiver, who's the business, are different. Therefore, the owner gets a tax deduction for the premium they pay, but the business is going to have to pay tax on the benefits. It's treated as income to the business. Now, that kind of washes out, frankly, because it's used to pay for overhead expenses, so they get to deduct it ultimately. But there's a relationship here that I'm trying to get you to understand. When the payer and the receiver are different, we back up. When the payer and the receiver are different, the premium is tax deductible to the payer, and the receiver is taxed on the income. That happens with employer and employee. That happens with business overhead expense insurance. But when the payer and the recipient are the same, now there's no tax deduction and the benefit is tax-free. So when would that occur? Well, let's go back. Well, when you buy your own, when it's personal, you don't get a tax deduction, no benefit for your, no tax on your benefit. But we also talked about key person disability insurance. Well, if you remember, the company pays and the company gets. So the payer and the receiver are the same. So no tax deduction to the company and the benefit's tax-free. The payer and the receiver are the same. With buy-sell agreements, disability buy-sell agreements, the payer and the receiver are the same. For example, with an entity purchase, the partnership pays the premium and gets the benefit. So the payer and the receiver are the same. Therefore, there's no tax deduction to the partnership to buy the disability income policy, but should the business, one of the partners, get disabled, the partnership gets the benefit tax-free. And even on a cross purchase, it's the same thing. With cross purchase, that's what I get for not looking as I type. I'm a terrible typist. Okay, so with cross purchase, it's the same thing. Each partner buys a policy on the other partner, and they pay for it. And if a partner becomes disabled, then each partner gets the benefit from the policy they bought. So the payer and the receiver are the same. So with cross purchase, disability, just like Annuity purchase, the payer gets no tax deduction for the premium they pay. And if a partner becomes disabled, the benefit that's received is received by the same person who paid the premium. Therefore, there's no tax on the benefit. The only time there's tax on the benefit is if the payer and the receiver are different. And that also creates a tax deduction to the payer. That only occurs in business overhead expense insurance and group disability income insurance by employers. Everything else works. Now, that's not perfect, but that's the best I can tell you to help you get that. If you have questions about it, get a hold of me offline and we'll try to go through it again. I don't mind doing that. But that is the best way I can do it without making you become a tax expert. So now we're going to talk about AD&D. We've already talked about accidental death and dismemberment, but we're going to review it. Remember, AD&D, accidental death and dismemberment, pays a benefit if somebody becomes disabled or is dismembered. Remember, full amount, principal sum, partial amount, capital sum. So let's go on to long-term care insurance. You asked me earlier, what's long-term care insurance? Well, long-term care insurance is an insurance policy that's under the medical expense part of the health insurance, but it doesn't pay medical bills in the same way your medical expense policy pays, like your HMO, your PPO. This is money provided so that you can pay someone to help you when you can no longer live an independent lifestyle. When you can no longer live an independent lifestyle, this is a policy that's there to provide dollars. So how does somebody qualify to get a benefit from a long-term care policy? Well, right here, that policy must provide a benefit for at least 12 months in a setting other than the acute care unit of a hospital. Now, I don't want you to become medical experts here, but understand, if anyone is in what's called the acute care unit of a hospital, they're sick. They need medical attention. They may need operations. They may need medicine. They may need all kinds of things. But that doesn't mean they cannot live an independent lifestyle once they get better. The anticipation is they're going to hopefully at least plateau, maybe get better so they can discharge them. But if somebody's in a scenario where they need long-term care, that's a progressively worsening situation. So understand what I'm trying to say to you here. A long-term care policy must be a policy that has to provide a benefit that will last for at least 12 months when a person is in a setting other than the acute care unit of a hospital. And that's basically going to mean they're not able to live an independent lifestyle. So the triggering event that must occur for someone to get a benefit from their long-term care policy is what's called the need for custodial care. And I know it's spelled wrong. Get over it. Custodial care, C-U-S-T. Matter of fact, let me fix it right now. Custodial care is the need for custodial care. Now, what is custodial care? Let me try to give you an overview. The kind of care that mothers and fathers, parents, provide for their infants is custodial care. Infants can't feed themselves. They can't bathe themselves. They can't walk around without help. Well, on the other end of the life cycle, somebody gets so old, they may be healthy, but they can no longer live an independent lifestyle. They need custodial care. Mommy and daddy are gone. So people who want to help us, like by feeding us and bathing us, want to get paid. So long-term care policies provide the dollars so we can do that. Now, understand the triggering event to get a benefit from long-term care must be the need for what we just described as custodial care. However, it will continue to provide benefit even if someone needs skilled care, intermediate care. So we're going to get in and talk about that. What is skilled care? Well, here's your definition. You need to know it. Skilled care is care that is needed daily, must be provided by skilled medical professionals, must be ordered by a physician. So these have to be RNs, LPNs, people who have licenses. You need licenses to stick needles in people and dose medication to them, especially if they're not your family. Intermediate care is the same as skilled care, but the frequency is less. It's other than daily. Still has to be skilled medical professionals, physician's orders. But custodial care occurs when someone is no longer able to perform two or more of what they call the activities of daily living. Anyone can provide this care. You don't need a special license to help somebody eat or to help bathe someone. And in many cases, family members provide that care for elderly family members. And by the way, it's not only elderly. There's sometimes young people get into accidents and become like vegetables. They need custodial care. Well, health insurance doesn't pay for that. Regular medical insurance doesn't pay for that. Long-term care insurance provides that. So let's talk about the activities of daily living. What are the activities of daily living? Well, eating, bathing, dressing, transferring, continence, and toileting. Those are the 6 activities of daily living. And if a person has a long-term care policy and the doctor has determined that they can no longer, without assistance, do 2 or more of any of those 6, that long-term care policy must trigger out a benefit. Any questions about what any of those activities of daily living mean? Okay. So those are the activities of daily living. When a person can no longer perform 2 or more of one of those, if they have a long-term care policy, it'll pay a benefit. Now, long-term care policies also provide what's called a home health care benefit, which means you're getting care in your own home. These are occasional visits that are medically necessary by licensed professionals. So, but remember, the triggering event must be the need for custodial care. Once that's in place, they still may need some other kind of care. So the policy doesn't stop paying just because they need what we'll call a higher level of care. Home convalescent care, another definition for you, is care provided in your home, but this is referred to as a planned program of recovery established by an attending physician. So here's an example. Mother falls and breaks her hip. She has to learn how to walk again. Normally, they would send her to a nursing home to rehabilitate her to learn how to walk again. But the doctor might know her very well and say, hey, Mary, you got all this dadgum exercise equipment at home. You can go home and we'll send somebody from the nursing home to see you to help you learn how to walk again. That's a planned program of recovery. And you remember, it's going to be provided by a member of the staff of one of these organizations. So we don't go to them, they come to us. That's home convalescent care. Then we have residential care. Now, residential care is a totally different animal. You're no longer at home. If you see a question about residential care, that means a person's in a retirement community. And one of the differences here, one of the similarities here, it's the same care that we listed under home care, but there's access to full-time nursing care if needed. There's usually at least an RN on-site 24/7, 365. So residential care is a level of care provided to those individuals who are in we call retirement communities. Then we have adult daycare. Long-term care policies must also provide a benefit that we call adult daycare. You see, many senior citizens are being cared for by their adult children, and they have to work. So the adult parent, the elderly parent, can't be left alone. They can't perform the activities of daily living. We can't say, hey, mom, don't go to the bathroom till we get home. So what we'll do is we can take them to if you understand daycare for kids, you understand daycare for the elderly. We drop them off at a daycare center where they're cared for and watched over, and we pick them up at the end of the day. It's also referred to as community-based care. No overnight stays, okay? Respite care. Respite care, this is a definition. Respite care is a different animal. Medicare has what's called respite care, and some long-term care policies will provide respite care. Respite, if you look it up, if you don't know what it means take a break. So respite care is for the caregiver. Imagine this. You're an adult child of a senior parent who needs this ongoing daily care because they can't provide for themselves. You're going to burn out. It gets tiresome. Even if you're not working, you'll wear out. So the policy will provide that you might drop mom or dad off at a facility so that you can take a break. So respite care is for the caregiver. That's what we're driving at here. The patient never gets a break. So how do long-term care policies work? What do they look like? Well, they're structured much like disability income policies. There's a benefit amount, a benefit period, and elimination period. But the methodology is a little different. See, under a disability income policy, if you remember, you were limited as to how much benefit you could receive tied to your income. That's not true with long-term care policies. You could choose a benefit as great as you want. How much can you afford to pay for? You pay a premium based upon the benefit you're going to receive. And that benefit could be a daily benefit or a monthly benefit. And I know it says selected by the customer, but that's really not accurate. Different insurance companies will have different procedures. One insurance company might provide a policy that has a daily benefit. We'll pay you $100 a day for every day you need care, or $200 a day, or $300 a day, whatever you want, you can buy. Or another insurance company might identify their benefit as monthly. We'll give you $3,000 a month if you need a benefit, $4,000 a month, $5,000 a month. And there's a difference. A daily benefit policy means you must receive care for the day to get reimbursed, if you will, for that day's care. Monthly benefit policy says if you get care one day in the month, you're going to get the check for the entire month, and then you have to budget it to last you the rest of the month. Monthly benefit policies have a higher premium than daily benefit policies. Long-term care policies also have an elimination period, just like disability income policies, but they count the days differently. With typical disability income policies, they count the days one at a time. You get disabled, you got a 30-day elimination period. If you're disabled after 30 days, on the 31st day, you begin to accrue some benefits from your policy. That's not the way it works under long-term care policies. Long-term care policies have two different ways they count down the days. One way is called the service day elimination period. Service day elimination period. Here's the way it works. Let's assume we have a 30-day elimination period in our long-term care policy, and it's identified as a service day elimination period. And somebody comes in on Monday to help me out. That's 1 day of service. Now I'm down to 29 days. And somebody doesn't come back till the following Wednesday. That's another day. Now I'm down to 28 days. So for every day I get care, I reduce my elimination period. If I only need help 1 day a week, it could take 30 weeks to use up my elimination period. But that's how it works. A calendar day elimination period, they calculate the days differently. If I get care 1 day in a week, that eliminates 7 days from my elimination period. So 1 day a week of care over 4 weeks would use up my 30-day elimination period. If you asked, most people would want the calendar day elimination period rather than the service day. But the premium is higher. for calendar day. So service day is 1 day is a day, calendar day, a day equals a week. Then we have benefit periods. And again, like disability income policies, they could be 2 years, at least 2 years, 3, 5, 10, could be lifetime. So once again, service day, a day equals a day, knocked off the elimination period. Calendar day, a day equals a week. We've already been through this. These are somewhat duplicative, but we're going to quickly go through them just as a reminder. It doesn't hurt you. So groups may not be formed for the sole purpose of buying insurance. Remember, there are 2 types. We talked about life insurance with 10. I said the only difference between life insurance and health insurance is the number of employees. Other than that, they're identical. The employer is the sponsor. The employees get certificates, 31-day enrollment. Participation is the same. Nothing changes other than the number needed. Group health, we need 2. Group life, we need 10. Association groups, same. 100, 5 years, constitution and bylaws. And this is duplicative, so I'm going to jump right through that. When they convert, 31 days. Remember, we went through this, so whether it's life or health, it's the same. COBRA, now I'm going to respell out COBRA. We went over it briefly, but I'm going to make sure we spend a little more time talking about COBRA. COBRA, we wrote it out earlier. What does it stand for? Consolidated Omnibus Budget Reconciliation Act. It's a federal law. It's not insurance. Don't get confused. It's not insurance. It only applies to groups of 20 or more. And what happens if an employee separates from service and they have group insurance and they work for a company with 20 or more employees, the law says they have to be allowed to stay on the group plan for at least 18 months. That's what we mean by extended group benefits for 18 months. Now, the 36 months is, I'm going to go to my worksheet here. The 36 months has to do with the spouse or widow and children. So if the employee is married and gets divorced, I should use the word ex-spouse, I apologize, ex-spouse. If the employee is married and gets divorced, then their ex-spouse and their children can stay on that group plan for an additional 18 months. Or if they die, their widow and children can, or widower and children can stay on. So the deal is the group benefits get extended to the employee. That's what I want to lock into here. The employee for 18 months. Their ex-spouse, widow or widower, and kids can stay on for an additional 18 months. That's where the 36 comes from. Now, the former employee has 60 days to decide whether or not they want to do it. They're not required to. It's the company's required to offer it. Now, if they decide to take the benefit under COBRA, the premium does not increase. Now, a lot of people who are in my live classes have experienced COBRA, and they say, well, yeah, my premium went up. No, it didn't. Your share went up. Because when you're on COBRA, the employer doesn't have to pay their share anymore. So we find out the employer wasn't such a rat after all. So whatever the employer was paying, now you have to pay. So the employee's perception is the premium has gone up, but it has not. The premium is the same. And in addition to that, COBRA allows the employer to charge a 2% administrative fee for handling the payment, because the process is that former employee sends the premium to the employer, and then the employer has to convert that into their account and then send the check to the insurance company, and they're allowed to charge a 2% administrative fee for that. So understand how COBRA works. HIPAA. HIPAA is another federal law. It stands for Health Insurance Portability and Accountability Act. I'm not going to take the time to write it out. You can Google it. Health Insurance Portability and Accountability Act, another federal law. And the main thrust of the Health Insurance Portability and Accountability Act is to provide what is referred to as portability of health insurance. Now, by portability, what they don't mean is this. I work for a company and I'm covered under a group plan with Anthem. And I leave that company and I find a new job and I can bring my Anthem policy with me. No, no, no. That doesn't mean that at all. It has to do with what is referred to as creditable coverage. Creditable coverage. And most of the questions you're going to get on the test will be about what happens if a person leaves one group and goes to another group. What kind of credits do they get to bring with them for the coverage they had with the old company? So let me do that. Creditable coverage. Let's assume that I work for an employer for 5 years and I've been covered under the group plan that whole period of time. That means I have 60 months of creditable coverage. And I leave that job and I find a new job within 63 days. I'll get back to this one in a minute, but I want to put it up there so I don't forget. So I find a new job within 63 days, and they also have group health insurance. Well, normally, when you find a company that's got a group health insurance, they make you go through a probationary period. It's 30, 60, 90 days. But they can't do that for me because they have to give me credit for the months of coverage I had under my old job to reduce that probationary period. So if my new company has a 90-day probationary period, they have to waive that because I qualify immediately because I have enough months of creditable coverage under my old job to get rid of that. Plus, if you remember, under group insurance, they can look back, 1 year to see if you have a pre-existing condition. Well, they have to waive that as well because I'm still going to get coverage. I get credit for those 60 months. So they have to waive that as well. So basically, they have to give me what are called special enrollment periods. They have to give me a special enrollment period. They can't make me go through a probationary period. They can't make me go through some pre-existing condition thing. They got to cover me immediately because I have enough what is called creditable coverage. That's the way it works. Pretty good deal. What's the 63 days about? Well, if someone has a break in coverage of more than 63 days, HIPAA does not apply. So they have no benefits. You can't have a break in coverage of more than 63 days. HIPAA does not apply. That's what the 63 is about. So they limit the exclusion for pre-existing conditions that we just went over. They can't discriminate against me in any way because of health. They got to give me special enrollment periods. They can't make me go through that elimination period or probationary period rather. Okay. And with individuals, don't worry about it. It's not on the test anymore. So 18 months of creditable coverage. There it is. Let's go on. I've already been through that. Just went over it. I'm not going to go over it again. Now, there's no waiting period ever for newborns and adopted children. In the world of health insurance, adopted children are treated as natural children when it comes to coverage, okay? And pregnancies as well. Pregnancies are excluded from any of the rules. Not too many questions about that. Now, you may get a question about renewability. And we talked about guaranteed renewable. And we already know guaranteed renewable means they have to renew it, but they can increase your premium, but only by class. However, you as a customer may cancel a policy at any time you want. You can do that anytime you want. And insurance companies can choose to non-renew or cancel if you don't pay your premium. Or if within 2 years they determine you've tried to get over on them. Or in a group plan where the employer violates that participation rate. Remember, 75%, 100%. Insurance company can drop people based on those reasons. Or if the insurance company just pulls the plan totally. So if the insurance company cancels a policy and it's done in the middle of the premium paying period, they got to give back some of the premium. They can't keep money that they haven't earned. So here's the deal. Let's take one step at a time. If the insured cancels a policy, they always have a right to cancel. I want you to understand, whenever we pay insurance premium, we pay in advance, okay? We pay in advance. Let me drop this down a minute. We pay in advance. We pay today for coverage from today forward. So if I pay $100 for 30 days worth of insurance, the insurance company hasn't earned that $100 just because I gave it to them. They earn that $100 one day at a time. Therefore, if the policy, let's assume the policy cancels for some reason on the 15th day, the insurance company has only earned $50. They've only earned half the premium because they only covered me for half the time. So therefore, if the policy cancels, the insured is entitled to a refund of unearned premium. How much of that refund they get back is determined by who cancels. If the insured cancels, they're going to get less than $50. They're going to be short. They call it a short rate refund. The insurance company is going to be able to keep some of that $50 for the administrative costs they incur because they didn't ask to cancel, you did. So you have to pay those costs. So you're going to get something less than $50. It's called a short rate refund. They're limited in law as how much they can take, but they are going to hang on to some of the money. Now, if the insurer cancels, assuming they can, then they must provide what's referred to as a pro rata or prorated refund of all unearned premium. So in my example, we're going to get back $50. Whoops, we're going to get back $50 because they have to give me a prorated refund. So you may get a test question talking about refund of unearned premium. So understand, if the insured cancels, it's short rated. If the insurance company cancels, it's prorated. And they're going to give you something. And it's not going to be a complicated question. Just be aware of how that works. Whoa, I had my finger on the button. Had my finger on the button. All right. Now, there are some questions about cancer and dread disease policies. Cancer and dread disease policies. So that's what they refer to them as. They're also called limited risk plans because they only will pay for some specific circumstances, like if somebody gets cancer, or if they have a heart problem, heart attack, or if they get confined to a hospital. There are many companies that sell policies that'll pay you so much per day for every day you go in the hospital. That's called a hospital confinement policy. There are companies that sell cancer policies where if you get diagnosed with internal cancer, you get a $5,000 check, and then for when you get treatment, they'll give you so much per treatment. However, here's the key. It's a semantic, it's an issue of semantics, ladies and gentlemen. A cancer or dread disease policy has what's called a schedule of benefits. Think of it like a menu. So a cancer policy under this concept of dread disease would mean it's not going to be a lump sum benefit. They're going to pay a specific amount every time you get treatment. $75 for this, $50 for that, whatever. Schedule of benefits. $100 per day for every day you go in the hospital confinement, that kind of thing. But if it's a critical illness policy, if you get a question that uses the words critical illness, now that's a lump sum payout upon diagnosis. So in the street, many cancer policies are a combination of critical illness and dread disease. They just don't label them that way. But the test, it's anal. The test is anal. So a critical illness policy would say, well, if you're diagnosed with internal cancer, we're going to pay you a lump sum of $5,000 or $10,000. So there are many cancer plans that will do that. Plus, they also have a schedule of benefits for other treatment. So it doesn't have to be one or the other. It's just the definition is different for your test. Dread disease, schedule of benefits. Critical illness, lump sum upon diagnosis. Most plans have a combination of both. Workers' comp. You and I can't sell workers' comp. That doesn't mean it won't be on your test. You need to be aware of what workers' comp is. And workers' compensation provides a benefit if there's an injury or illness that's a result of a work-related event. Must be work-related. Somebody who has group insurance at work, that group insurance at work only covers them for non-work-related illnesses and injuries. It's referred to as a non-occupational policy because they have workers' comp to take care of work-related illnesses and injuries. Now, with workers' comp, you may get a question. The worker cannot sue to get benefits because the law says they get benefits. It's available by statute. Now, the employee might have to sue to prove it was work-related, but once it's been determined it's work-related, they're getting their benefits. And it's without regard to fault or negligence. The employee doesn't have to prove that somebody was at fault. They only have to prove it was work-related. Now, workers' comp has 4 primary benefits: medical, income, death, and rehab. The 2 that seem to show up most often on the test is the first one and the last one. So medical benefits, I have in parentheses, without limit. Now, there's still a limit, but understand it this way. If you need a wrist brace because you got hurt at work, they can't give you $20 to send you to Walmart to buy a Ace bandage, okay? They have to provide whatever wrist brace they need to without regard to the cost, okay? On the other hand, rehab, it says not 100%. It is not a requirement under workers' compensation rules that if a person becomes injured, that they get 100% rehabilitated. Because if you think about it, it may not be possible. I mean, some poor employee loses a limb in the course of work. How the dickens are we going to get him 100% rehabilitated? I mean, even if we get him a great prosthetic, it's not 100%. So it's not a requirement that they get him 100%. So watch for that on your test. The word subrogation. Subrogation is a legal term. You may be familiar with it. But what it boils down to is you can't collect twice. See, if you have auto insurance and you got liability and comp and collision, if somebody hits you and it's their fault, your insurance company is going to pay to fix their car even though they may not have insurance. You're going to be taken care of because your insurance company promises to do that. And they're going to sue that person to try to get their money back. You can't sue them as well because you've already been paid. Okay? You subrogate. You give up your right to sue because you can't collect twice. That goes back to the indemnity concept we talked about earlier. We already talked about these mandatory provisions. We're not going to go over them again in great detail. But the purpose of those provisions were what? To define the rights and duties of both the insurance company and the insured. Now, one of the things we didn't cover is this. These provisions, clauses, and riders are part of law, but they may be reworded, but they cannot be less favorable. Let me explain to you what I mean. One of the provisions is the contestability clause we discussed, where once the policy has been enforced for 2 years, the insurance company can no longer contest any of the answers. Now, an insurance company, if they want, they can shorten that contestability period to 1 year. That's better for the customer. They can't make it 3, okay? They can't make it 3. Now, also, we've introduced a new term to you here, NAIC. So we're going to talk about the NAIC. The NAIC, 55 or so egomaniacs, I refer to them as egomaniacs, who run the various bureaus of insurance across all of the jurisdictions we discussed. And the NAIC, one of the things they do is they get together on a regular basis. They have meetings, and they thrash out their differences about how to handle things. I mean, each of these people have their own ideas as to how things ought to be done because they all have their own jurisdiction. But to create a continuity of regulations across the country, they get together and try to come up with what are referred to as model laws. They create what are called model laws. And these laws are designed so that the rules aren't very different among the states. Because one of the things I think I said to you yesterday is that the states are the primary regulator of insurance. It wasn't always that way. We'll talk about it later. But the states are the primary regulator of insurance, which means the feds are looking over the shoulders of the states like a hungry wolf. And if the states make it difficult for insurance companies to do business among the states, they're going to make some law to force it. So the states don't want that to happen. So what they do is they get together and they create these model laws that creates a continuity of regulation so the feds stay out of our hair. As an example, once you get your insurance license in the Commonwealth of Virginia, your life, health, and annuity license, you can go to any state in the union and get a license as a non-resident in that state, and you don't have to take the test. All you have to do is fill out a form and pay a fee because your license in Virginia is going to be sufficient to meet the regulations you need to meet to get licensed in North Carolina or Maryland or any other state. That's a benefit. You with me? So NAIC creates model laws. Among those model laws is this law that we just discussed called the Uniform Accident and Sickness Policy Provisions Law, a model law developed by the NAIC. There are 24 provisions, 13 mandatory, 11 optional. I alluded to them earlier today. We talked about the entire contract provision. Nothing new here. Any change is made by an executive officer, right? We ask for the change, but unless an executive officer issues an endorsement which reflects the change isn't made. Grace period, we've already talked about. In health insurance, the grace period is determined by what? The mode of payment. We already went through this. Less frequently than monthly, 31 days. We did the reinstatement. I'm going to jump through that. Beneficiary, we'll talk about beneficiary. I think we mentioned that beneficiaries are revocable or not irrevocable. And we've already discussed this. So beneficiaries, we can change them like we change socks unless we name them as irrevocable, and then we must get their written permission. We've already discussed the vested interest thing. But this part is important for health insurance. Under those traditional policies, the ones we talked about earlier, those reimbursement policies where we would get a bill and submit it to the insurance company, there are some questions about that process. And now we're going to address those questions. So if we're going to expect our insurance company to pay us, we have to notify them that we have a claim because they want that claim submitted on a form that they want to see. They don't want us to give them the claim information on the back of a napkin. So we have to provide them what's called a notice of claim. We have to notify them in writing within 20 days of the loss. A way to remember the 20 days is what do you do? Let me rephrase that. Look at the word notice. What body part do we use to notice things? Our eyes. And what's perfect vision? 20/20. So I want you to utilize that perhaps as an effort to help you remember this number. Notice 20/20. Notice 20/20. We have to notify the insurance company within 20 days of the loss so that they will provide us with a claim form so that we can fill out that form to send back to them so we can get paid. They have 15 days to get us the claim form. You need to know the number 15. The way I suggest you remember it is that the word form and 15 both begin with the letter F. Forms 15. So notice it's 2020, forms 15. Once you get the claim form, you'll fill it out. They got to get it to you within 15 days. Now, if they don't get it to you within 15 days, you can put it on the back of a napkin, but I promise you they get it to you, okay? So once you get the claim form, you fill it out to file your proof of loss. And proof of loss must be submitted within 90 days of getting that claim form. And the way to remember it is, once you're done with all of this, you're going to want to do 90 proof for 90 days, okay? 90 proof. That's a poor attempt at humor. 90 proof, 90 days. So there are 3 questions that should you get them on the test, they ought to jump off the page. Notice 2020. Forms 15. Notice proof 90 days, 90 proof. Okay? So they show up on the test. Those are time frames under those traditional policies or reimbursement policies that we have to have these stuff done. Time payment of claims. Once they get that claim form, they have to pay us. Question, how quickly? Answer, immediately. Now, you're going to find out in a minute. Immediate doesn't mean immediate. You can't go in there and bang on the controller's door and expect to walk out of there with a check. You have to give them a reasonable period of time to process. But you may get a question, and the word immediate might be your answer. You take it. They have to pay you immediately upon receiving proof of loss. And disability benefits cannot be paid quarterly, semi-annually, or annually. So disability benefits cannot be paid less frequently than every 30 days. There's that less frequently crap again, huh? They can pay you weekly. They can pay you twice a month, monthly, but not quarterly. Payment of claims. Payment of claims is who gets the money. What under those reimbursement policies, those traditional policies, the check's going to go to the insured. They're going to get reimbursed unless they what? Assign the benefit to the doctor, but it's designed to go to the insured if the insured's alive. If the insured's not alive, it's going to go to a beneficiary that the insured would have named in the application. If there's no beneficiary, as we said earlier, if there's no beneficiary, then it goes to the estate of the insured, right? Goes to the estate of the insured. Don't worry about facility payment clause. Physical exams and autopsies. Insurance companies have a right to do physical exams and even autopsies, especially in a life insurance scenario. But if they want one, they got to pay for it, okay? So they have a right to them. They have to pay for them. Also, I want you to make a note. Insurance companies may never, ever, never, ever do an autopsy unless you're dead. No autopsies allowed on live people. Another poor attempt at humor. Sorry for the poor humor, but I got to do something to brighten your day because you're already probably getting ready to fall asleep. This is tedious. I know it. But the insurance company has to pay. Time limit on certain defenses. That is the fancy way of talking about what? The incontestable clause, which is how long? 2 years if the contract's guaranteed renewable. That's also true in life insurance, period. 2 years. 2 years also deals with what? Pre-existing conditions. Oops, I just realized that. Pre-existing conditions for health insurance. Pre-existing conditions. Every now and then, if I see it, I'll fix it. Okay. Legal action. So, if they don't pay us, we can sue them. You got to wait at least 60 days. So, earlier when I said immediately, and I was trying to make fun of that, the reality is you can't sue them for at least 60 days. You got to give them time to process the check. But if they haven't paid you within 60 days, you can sue them. But you better sue them within 3 years. Virginia has a 3-year statute of limitation when it comes to suing an insurer for not paying you. I don't know in all of my career anybody ever happened to do that, but these are numbers and facts you need to know for your test. Once again, we talked about cancellation, right? If the insurance company cancels the policy, assuming they can, you're going to get a prorated refund of all unearned premium. And this phrase is important. What does it say? Without prejudice to any existing claims. Here's the deal, ladies and gentlemen. If an insurance company is able to and cancels a policy, they're canceling for future claims. If they've already made an agreement and have already agreed to pay your current claim, they can't stop paying it. They can't throw you out of the hospital, okay? So they can't, what the term they use is prejudice existing claims. They got to continue to pay existing claims. And then if the insurer ed cancels, remember, if the insurer ed cancels, it's a what? Short-rated refund. Now, there's some optional provisions. Optional provisions, as we said, protect the insurance company. We already talked about some of these. This one we have not talked about. Hazardous occupations. In health insurance, especially in health insurance, not in life, but in health insurance so much. I mean, not in life so much, but in health. Occupation is a problem. Premium-wise, librarians will pay less than steel workers. So if a librarian gets a health insurance policy and then later decides to become a steel worker, if he tells the insurance company, they're going to raise his premium. They can do that. So the tendency might be he won't tell them. So how does the insurance company protect itself? By adding this additional optional provision to the policy called change of occupation. And it says, if you change your occupation from a less hazardous occupation to a more hazardous occupation and don't tell us, then we find out after the claim comes in, we're going to adjust your benefit to pay you what you would receive based upon the premium you paid applied to the more hazardous occupation. No harm, no foul. Now, if somebody goes from a more hazardous job to a less hazardous job and doesn't tell the insurance company, I call that stupid. But if they didn't and the insurance company finds out, they will give them a prorated refund of unearned premium. They're not allowed to keep more than they're entitled, nor do they want to pay out more than they're supposed to. Misstatement of age and gender, we've already discussed that. Benefits will be adjusted but would have been paid based upon the correct age or gender. And remember, it's gender at birth. Illegal occupation. This is for health insurance. If we have a bank robber that's insured under a health insurance policy, insurance company probably wouldn't want to pay if this guy gets shot holding up the bank. But they will have to pay the claim unless they add this optional provision called illegal occupation. So if the injury or illness is a result of the illegal occupation, with this provision, the insurance company doesn't have to pay the claim. If you were an insurance company, I promise you, you'd add these optional provisions. We've already discussed the fact that there's an insuring clause. Insuring clauses are on the first page. They identify the insured, the insurance company, and what's covered. Free look, we've already discussed to some extent. Free look begins from the date we deliver the policy. That's why we need the date on the policy delivery receipt. It's normally 10 days, but as I said earlier, but here it is in writing, it's 30 days for long-term care and med-sup. They give old people more time, okay? It's not free insurance, remember. Coverage is enforced during the free look period. So when a claim comes in, they'll pay it, but it's not free insurance. It's a free look. But if you don't like it, you can get your money back. The consideration clause is also on the first page. And it deals with specifically that the application in premium is the customer's consideration and the company, and it spells out more detail the company's promises to pay. Elimination period, we've already discussed it. With health insurance and life insurance, they're identical. The difference is the time frame. I believe I've already gone over this. With health insurance, it's 3 months. With life insurance, it's 6 months. If you're totally disabled, pay the premium for at least 3 months if you're health insurance, 6 months for life insurance. Then after the end, they give you back the money at the end of that period of time. If you're still disabled, they give you your money back and waive all future premiums as long as you're disabled before you're 65. So whether it's life or health, the rule is identical except for the time frame. You have to pay the payments for 6 months for life, 3 months for disability. But it's an optional provision. It's a rider you have to add to the policy. It's called waiver of premium. Now, earlier we talked about recurrent. Remember we talked about reoccur, relapse? Remember, if you have a disability where you are out of work and then you go back to work and you have a reoccurrence within 6 months, it's a continuation of the original. We just went over that. You were writing some of it down. And then if it's more than 6 months, it's considered a new disability. Well, residual is different, but the words look alike. Years ago, they used to have a provision that provided a benefit if you were partially disabled. The problem with that benefit was if you went back to work and earned any money, they took away your benefits. So they modified it, and they created what we now call a residual benefit. A residual benefit provides a benefit and we're going to give you an example, but it provides a benefit that's based upon the percentage of pre-disability income you lose. So here's how it works. Same guy we had before, right? Same scenario. He has a heart attack. He's out for a year. So he lost 100% of his pre-disability income. Under the residual clause, what's going to happen is they're going to say, oh, you lost 100% of your pre-disability income. We're going to pay you 100% of the benefit, $3,000. If you go back to work and make half of your income, now you've lost 50% of your pre-disability income. We're going to give you half your benefit, or $1,500. This is an incentive to get that person to go back to work. It gets them off claim more quickly, and it helps the insurance company as well. So just a quick review. The residual benefit works how? If you lose 100% of your benefit, 100% of your income, the policy pays 100% of your benefit. And in my example, that's $3,000. If you go back to work, the policy will only going to pay half if you're earning half your income. So now you got $4,000 coming in. So you're incentivized. The more you work, the more you make. That's the way it works. Recapping as well, co-insurance, stop loss. We didn't talk about stop loss. We did not talk about out-of-pocket maximum. We're going to discuss that. Co-insurance. Co-insurance, remember, you pay your deductible first. This is in health insurance. Then once you pay your deductible, the company's going to pay the larger of some percentage. We kind of went over that. Stop loss is a new concept for you. Stop loss is a dollar amount. It's a dollar amount identified in the policy that says once the bill hits a certain number, the insurance company will pay 100% of the bill from that day forward. So think of it this way. Once the bill hits a certain number, the insured stops losing. It's called stop loss. Now, if we know the insured's deductible, if we know what his deductible is, if we know what the co-insurance is, and if we know what the stop loss limit is, we can calculate the most money they're ever going to have to pay out of their pocket when a loss occurs. It's called the out-of-pocket maximum. So we have an example. This may help you understand. So John has a major medical policy, $500 deductible, 80/20 co-insurance, $5,000 stop loss. Once we get done with this example, I realize we're running late. We'll take a break about 1 o'clock. We'll take 45 minutes. Okay. John is major medical. $500 deductible, 80/20 co-insurance, $5,000 stop loss. You see, they have it identified. The bill's $3,000. How much will he pay? Well, I'm going to give you the answer. It's $1,000. What's more important than the answer here is knowing how we got there. So let's figure that out. The bill was $3,000. The deductible was $500. So we subtract the deductible from the bill, $2,500. We multiply that by 20%, another $500. We add it together, that's what he pays, $1,000. Well, what happened to this? What happened to the stop loss? Well, the bill never reached stop loss, so it doesn't matter. They throw it in there to confuse you. You don't have to worry about that. If the bill is less than the stop loss, you start with the bill. Let's change it, however. Let's talk about what happens with stop loss. Same question, but now the bill's $18,000. How much will he pay? Answer is $1,400. And here's why. The bill was $18,000, but the stop loss is $5,000. So now we're going to utilize stop loss in our calculation. He only shares in the bill up to the stop loss. Therefore, that's where we start. Subtract the deductible, so multiply it by 20%, add them together. That's what he pays. And the bill could go to $180,000 because of the deductible. He's never going to pay more than $1,400. I hope that makes sense. One last thing before we go to lunch. If you get a question similar to this, and it asks you, how much does the insurance company pay? Don't freak out and try to recalculate. Figure out, using what we just showed you, how much does the insured pay? And then subtract it. Like in this example, the insurer paid $1,400. Subtract it from the $18,000. That'll tell you how much the insurance company pays. I think you see that, but I'm obligated to make sure you see that, okay? That's the kind of math you may see on the test. So, co-insurance we've already discussed. 90-10, 80-20, 75-25, and deductible. Oh, we'll talk about deductibles after we get back from lunch. So it's 12:48. Let's break. Let's be back here by 1:30, okay? 1:35, and we'll pick up where we left off, and we'll get done for today. So we already discussed coinsurance, and there's nothing new here. It's just extra slides that I have. We'll have to reorganize this. And deductibles. Now, deductibles come in different flavors. We have what's called an annual deductible. That's the most common. Annual deductible basically says every year you have to pay so much out of your pocket before the insurance company will pay anything. So annual deductible is very common. However, some policies, very rare, have what's called a per occurrence deductible. And that works much like your auto insurance, where every time you have an event, you got to pay a deductible. A family deductible and a corridor deductible. Let's go over them one at a time again. Annual deductible has what's called a carryover provision. The carryover provision on an annual deductible is pretty simple. If my deductible this year is $500, and in the last quarter of the year, October, November, December, is the only time I go to the doctor and I pay $300, I haven't met my deductible. So the $300 that I did spend will carry over to the new year to help me meet my new deductible. So my new year deductible is going to be $200. So my deductible of $500 a year is what I have to pay. But if I happen to be healthy and don't go to the doctor except in the last calendar quarter, any money I spend towards the deductible in the last calendar quarter will carry over to the new year to help reduce my deductible for the new year. That's the carryover provision. Per occurrence deductible, as I said, is similar to your auto insurance. Family deductible. My mother was the oldest of 21 children, same mom and dad. And if Grandpa had a health insurance policy with a $100 deductible on each kid, he'd have gone broke before the policy would have paid anything. So a family deductible would have helped him because it would have capped out and paid off, met his deductible after 2 or 3 of his children met the deductible. This is a benefit set up for large families. And corridor deductible, remember we talked about this, we talked about those traditional policies. Supplemental major medical policies have corridor deductibles. Then we have what's called a common accident deductible. A common accident deductible kind of works like this. Let's assume we have 2 people insured by the same company, same insurance company, and the policy has a common accident deductible. And they happen to be in a building, they don't even know each other, they happen to be in a building that collapses and they both get injured. Well, the insurance company is only going to require that one deductible be paid between the 2 of them. It's common accident provision deductible. Co-payments, we've already discussed. Set dollar amount for every time you get medical service. It's kind of like your admission to get on the ride. Okay. Some exclusions that show up on the test. An exclusion is an excuse for an insurance company not to pay. But now maternity, for your test, is treated differently in group plans as opposed to individual plans. The Affordable Care Act notwithstanding here. Remember I said there's always this dichotomy going on between the Affordable Care Act and what's going on the test. So maternity would be optional for individual policies. In other words, individual policy owners did not have to buy maternity if they didn't want to. But mandatory for group. So typical question, Mary's 3 months pregnant. She goes to work for a company and they have a 90-day probationary period. At the end of the 90 days, she's now 6 months pregnant. Is her pregnancy covered? Yes. They cannot treat the pregnancy as a pre-existing condition. It's unique exclusion. So mandatory for group. They can't treat pregnancy as a pre-existing condition. You may get some questions about mental and emotional benefits and limited and substance abuse benefits. They're very limited. They're generally not the full benefit. I don't remember seeing too many questions at all about that on the test, but in case you get them. And then there are other exclusions. Obviously, if somebody's in the military is going to take care of their medical bills. Self-inflicted injuries are never covered. That's why that all those definitions about accidental that we talked about. So self-inflicted is always going to be an exclusion. Now, when it comes to dental, cosmetic, and refractions, we need to clarify. Most health insurance policies will pay if you need dental surgery, cosmetic surgery, or eye surgery. That's the word they're using. I wish they'd use a different word, refractions. If you need dental surgery, cosmetic surgery, or eye surgery as a result of the fact that there was some traumatic event that occurred that requires reconstructive surgery, it is not covered. These are not covered if they are elective surgery. So if you just want to make yourself look pretty or fix your eyes, that ain't going to cover it. So dental, cosmetic, and refractions would be covered if they are necessary, medically necessary, because of some traumatic event. And then the same would be true with care in government facilities. That's an exclusion. If somebody's being cared for in a government facility, government is paying for it, so the private policy won't. This is just a matter of understanding what the words mean. Usual, reasonable, and customary. And sometimes you'll see them twisted around and make it usual, customary, and reasonable. URC, UCR, it doesn't matter. So what that means, what a policy, a health insurance policy that uses the usual, reasonable, and customary process in paying claims, look what it says. The payment was based upon the average charge in a given geographic area. You're not given this menu or schedule of benefits. They're just going to figure out what is the average payment for that procedure in that geographic area, and that's what that policy pays. See, most policies have a schedule benefit. Okay, most policies will tell you what, so much for this, so much for that. Riders, we mentioned earlier today that an impairment rider, we talked about it, the bad back, remember? Permanent exclusion. Now, in disability income insurance, we also have what's called the guaranteed insurability rider. And it's a slightly different than the guaranteed insurability rider in life insurance. Thinking back to the guaranteed insurability rider in life insurance, remember 6 times from age 25 to 40, they could buy an additional policy without having to prove they're insurable, specific ages or events of life. Well, this is a little different. This is for disability income insurance. So they also refer to it as a future increase option. Let's assume somebody's making $5,000 a month and they buy a policy with a $3,000 a month benefit. They can do that. That's within the realm, 60%. And let's assume now 5 years later, they're making $10,000 a month and they might like to add $3,000 more to their benefit to keep their ratio of benefit to income. If they're not insurable, it's not going to happen. So if they added this rider when they bought the policy, what will happen is every couple of years, they can go to the insurance company and without having to prove they're insurable, add additional benefit, monthly benefits to their policy. As long as their income has gone up, they can add the proportionate benefit. So it's a pretty good deal, and you have to pay extra for it, but it does allow them to add more monthly benefits every few years as their income rises. We already discussed multiple indemnity. It's like double indemnity. It doubles or triple the benefit if the accident occurs. Now, rights of renewability. We're back to this word renewability again. We've covered it from a number of different points of view. Almost every health insurance policy in Virginia is guaranteed renewable. Just to review, that means they must renew it, but they can increase your premium, but only by class. However, even though most all policies are guaranteed renewable, they still ask questions about these others that are like almost obsolete. So you need to understand what they mean when they're talking about a cancelable policy. A cancelable policy is a policy the insurance company can cancel at any time for any reason. Nobody wants them. I wouldn't want one. The only thing they have to do is give you 5 days notice, but you need to know that little fact. A cancelable policy is one that the insurance company can cancel at any time for any reason The only thing they have to do is give you 5 days notice. Now, there also used to be policies that were referred to as optionally renewable, which means the insurance company had an option as to whether to renew your contract or not, but they could only exercise that option when the premium comes due or a renewal date. They didn't have to give you a reason, but when their due date came up or a renewal date happened, the insurance company could just choose not to renew. Again, these don't even exist anymore. Then we have conditionally renewable. Very similar to optionally renewable, except that now they got to give you a reason. Again, these are they don't exist. 99.9% of all policies are what? Guaranteed renewable, which means they can increase your premium, but only by class. And then we have another one that sometimes shows up in your test. It's called non-cancelable guaranteed renewable. And if you're fortunate enough to get a non-cancelable guaranteed renewable policy, you don't ever want to let it go because they can never increase your premium. Ever. So there's a big difference between guaranteed renewable and non-cancelable guaranteed renewable. With non-cancelable, when you think of it, non-can can never. Non-can can never increase premium. These are also rare. 99.9% of all policies are guaranteed renewable. Now, one of the questions you may get is the comparison in the premium that might be paid, all things being equal, which of these policies will have the higher or the lower premium? Well, here's your answer. Cancelable would have the lowest premium of all, and non-cancelable guaranteed renewable would have the highest premium, at least to start. So that's the type of question you might get. Then we have what's called period of time insurance. Period of time insurance. And period of time insurance can never be renewed. It's like term insurance for health insurance, but it can't be renewed. They also refer to these policies as blanket policies. They call them blanket policies. And here's the concept, if you can visualize this, please. If you had a room full of people and you covered everybody in that room under a blanket and you looked down on the top of that blanket, everybody would be covered, but you wouldn't know who's who. There's no individual identification. Most every health insurance policy requires that we identify who are the insureds, who are those that are insured. They want to name the insureds, named insureds. The exception to that rule is this blanket policy. One of the things about blanket policies that you may be asked about is there is no requirement to individually identify each person. Also, another question you may get is, when would these be used? Well, let's assume I'm a scoutmaster and I'm going to take a bunch of Boy Scouts out on a camping trip next week. I need to get some insurance in case one of those kids gets sick or hurt on the trip. So I go to a company that sells this stuff, and these are the kinds of questions they're going to ask me. One, where are you going? When are you coming back? And approximately how many people are going. That's all they want to know. They don't care who. They don't want to know exactly. They just want to know approximately. And I tell them. So anybody who shows up that morning to go on the camping trip is covered. And when the trip is over, the policy expires. If we go out another time next week, 2 weeks later, I got to get another policy. These are also used in many instances with schools that take kids out on field trips. They'll use what are called blanket policies for that as well. Social insurance. Social insurance. Medicare, Medicaid. Medicare, federal health insurance, primarily for people 65 and older. Also, for people who have what's commonly called Lou Gehrig's disease. ALS stands for amyotrophic lateral sclerosis. So those folks also get Medicare. And anyone who's been collecting a Social Security disability check for 24 months. It's called SSDI. So Medicare is available as a federal health insurance program for anybody 65 and older, Also those who are on dialysis and those collecting SSDI for 24 months. Medicaid, on the other hand, is health insurance for those who are financially challenged. I think we covered this, but we're going to review it again. Medicaid, state and federal funds, remember, those on welfare. So Medicare, now here we got to drill down a little deeper. Medicare has 4 parts. Medicare has 4 parts. Part A is the hospital insurance. It helps those on Medicare pay the hospital bill. It doesn't pay the bill, it helps pay the bill. It's automatic and mandatory for everybody 65 and older. Warren Buffett is on Medicare. Bill Gates, when he turns 65, will be on Medicare. Everybody 65 and older, automatic and mandatory. There's no insurance company that will sell you an insurance policy, private insurance policy for health insurance if you're 65 or older, because that's what Medicare is for. No additional premium. It's not free. Be careful, not free. Remember that 2.9% tax we talked about earlier yesterday? Well, that's what pays for Medicare Part A. There's no additional premium. It's already been paid for. Part B is medical insurance. Part B helps pay for the doctor. It's optional. Got to pay extra for it. People on Social Security, it generally comes right out of their Social Security check. Now, sorry, let me go back. So most Americans, senior citizens especially, who are 65 and older, have both Part A and Part B. That's referred to as traditional Medicare. That's what they call it, traditional Medicare. And traditional Medicare does not pay all the bills. There's a lot of things traditional Medicare doesn't pay for. We're going to get into some of that. So what people do to help them pay for what Medicare doesn't pay for is they may buy what's called a Medicare supplement policy. We talked about that briefly, a Medicare supplement policy. These are policies issued by insurance companies to help pay for things Medicare doesn't pay for. Not everybody can afford them. So what some people do is they may opt out of traditional Medicare, and get their Medicare benefits through what's called Part C. Part C is also called Medicare Advantage. You might write that down. Part C is called Medicare Advantage. So here's what will happen. They're still in Medicare. Make no mistake, they're still in Medicare. And they're still going to get their A and B benefits. But instead of receiving their A and B benefits through Medicare, they're going to receive their A and B benefits through an insurance company. So let me try to clarify. Under traditional Medicare, this is the basic process. Let's assume you go to a doctor and the doctor treats you. You hand the doctor, if you're on Medicare, you hand your doctor your red, white, and blue Medicare card. The doctor will bill Medicare. And Medicare will reimburse the doctor about 80% of Medicare's approved charge. A few things we got to cover here. So under traditional Medicare, you go to a hospital or a doctor, they will bill Medicare and then they get reimbursed. If you go to the doctor is going to get reimbursed about 80% of its approved charge. So let's assume mother goes to a doctor. Oh, I have to tell you also, in Medicare, doctors are classified in one of two ways. Some doctors are referred to as participating physicians, and other doctors are referred to as non-participating physicians. That's the doctor's choice. So if the doctor that mother goes to, or the Medicare recipient goes to a participating physician, what does that mean? That means that physician has agreed to accept Medicare approved charge as full payment. And if they go to a non-participating physician, the non-participating physician has not agreed to that. So how does that work? Well, let's go back. Let's assume mother goes to the doctor. He's a participating physician. And let's assume the bill that he bills Medicare for the service is $100. That's the bill. And Medicare is going to review that bill when they get it, and they're going to make a determination what is their approved charge for the services that were provided. And let's assume Medicare's, let me change that number. Okay, let me just change that number to make it easier. Let's assume the bill was $125. Okay, and Medicare reviews that and they say, our approved charge for that service is $100. So they're going to send the doctor, the participating physician, $80. And mom, the Medicare recipient, has to pay $20. Well, what happens to the $25 excess? The physician has to write it off. They can't charge the patient the other $25 because they've agreed to accept Medicare's approved charge as full payment. Now, in the same scenario, if mother goes to a non-participating physician and we have the same set of numbers, then what happens is mother's also going to have to pay the $25 referred to as excess bill. The non-participating physician is allowed to bill the patient the excess above what Medicare approves. So as Medicare recipients, we go to doctors that are participating, not non-participating. And a lot of people don't know that, but that's the reality of it. So understand how it works. The numbers are not that important, but we understand how it works. So Medicare Part B helps pay up to 80% of your doctor bill. That's what Medicare does. Now, if a person opts out of traditional Medicare and chooses instead to use Part C, which I have said to you is referred to as Medicare Advantage, then what they've really done, is enroll in an HMO or a PPO, which is provided by what? A private insurance company. Humana, Aetna, there's a bunch of them out there. So for your test, understand this person is still in Medicare. They haven't opted out of Medicare. They just opted out of traditional Medicare, and they're going to receive their Medicare Part A and B benefits through the insurance company rather than have the doctor billing Medicare. The doctors in Part C are part of networks, remember? Medicare Advantage, HMOs and PPOs, they're networks. So the doctors are being paid by the insurance company. That's what you need to know. So somebody would have A and B, traditional Medicare, or opt out and end up in Part C, still getting their Medicare benefits, but in a different manner. Then we have Part D. The fourth part of Medicare is Part D. Part D stands for self-administered prescription drugs. I know I don't have the word self-administered up there, but you might want to make sure you jot that down. Self-administered prescription drugs. Medicare does not pay for any self-administered prescription drugs. If someone on Medicare wants help paying for their self-administered prescription drugs, they're going to have to buy an insurance policy from a private insurance company called the Medicare Part D plan. They're regulated by the feds, but they're sold by private insurance companies. So if we go to the hospital and in Medicare and we need prescriptions drugs while we're in the hospital, Medicare Part A will pay for that because that's paid as part of the hospital stay. If we go to the doctor and the doctor gives us a shot or doses us medication in the visit, that's part of Part B. Part B will pay for that. But if the doctor gives us a prescription to go to the drugstore to get filled, that's a self-administered prescription drug. Medicare doesn't pay for that. So the only way we can get help paying for that is to buy a private insurance policy from an insurance company referred to as Part D, prescription drug. So here's the normal scenario. Somebody who's on traditional Medicare would have A, B, and SMART if they would buy a D, A, B, and D. And to help pay for what Medicare doesn't pay, they might buy a Medicare supplement policy to fill the gaps. We'll be talking about Medicare supplement shortly. However, a person could totally opt out of A and B, traditional Medicare, and opt into Part C, and that would be called Medicare Advantage. And those Part C plans automatically include Part D. So we have MAPD. They refer to it as MAPD, Medicare Advantage Part D, all in one group. You probably don't need to know all of that, but it's something you should be aware of. All right. So what does Part A pay for? Part A pays if you go to the hospital, inpatient. It'll also help pay for inpatient skilled nursing. It'll also help pay for home health care. We discussed earlier about home health care. Hospice. Medicare provides a benefit if somebody becomes terminally ill. Hospice is a benefit to provide care for someone who's terminally ill. How do you qualify? We've already kind of been through this. 65 and older, if you're on Social Security DI, SSDI, or end stage or ALS, you get Medicare. The test isn't going into the details that my slides use. I'm just going to kind of go through this to give you an idea, but it's not that critical. But I want you to have, because you may get some questions here. Because Medicare Part A is weird. It's not like any other health insurance program you have ever run across. Part A operates on what's referred to as a benefit period. See, most health insurance policies work on an annual basis. You have an annual deductible, and then every year you start a new deductible. Well, that doesn't work that way in Medicare. Part A is what's called a benefit period. So a benefit period begins when a person is admitted to a hospital. And for the first 60 days, Medicare will pay 100% of that hospital bill, except for TVs, telephones, and private duty nurses. Also, what I don't have up there, and I should, I'm going to put it up there now, I just realized, that Medicare recipient must pay what's called a benefit period deductible. It's a deductible that they have to pay every time a new benefit period begins. And right now, the benefit period deductible is around $1,300. So visualize, mother falls and breaks her hip. She goes to the hospital. She's going to have to pay a deductible close to $1,300. And then for the first 60 days of her hospital stay, Medicare will pay 100% of the the first 60 days. But no TVs, no telephones, no private duty nursing. Now, what a lot of hospitals have done, almost everyone that I know, they no longer bill separately for TVs and telephones. They include it in the bill. Now, let's assume mom broke her hip and she went into the hospital and she had some real complications from the surgery. And she had to lay there for 60 days. Okay? And then they discharge her. See, the benefit period begins, as it says, when what? We get admitted to the hospital. Look at the bottom of the slide. What does it say? The benefit period ends when they've been discharged for 60 consecutive days. And this can be a problem. A benefit period is weird. It begins when you go to the hospital, and it ends once you've been discharged for 60 consecutive days. So follow with me. Matter of fact, on the next slide, I think I've got some pictures. Yes, this is better for you. Let's tell our little narrative. So mother falls and breaks her hip. Okay, mother falls and breaks her hip. She's on Medicare, so she has to go into the hospital. So the first thing that has to happen, her benefit period is going to start, and Medicare will pay 100% of the bill for the first 60 days once she pays that benefit period deductible. And you can see in 2009, it was $1,068. It goes up every year. No TVs, telephones, and nurses. Okay, so she lays there for 60 days. She has some real complications from the surgery, and they finally get around to discharging her, and they send her home. 2 weeks later, she comes down with pneumonia. She has not been home for 60 consecutive days, so she's still in the same benefit period, and now she's in the second phase. So for the next 30 days, Medicare is going to pay everything other than, in 2009, it was $267 a day. It's closer to $300 a day now. You don't need to know the number. So in the phase 2, she's got to reach into her pocket to pay a copay for every day of those 30 days. And let's just assume that mom has had some real complications as well from this pneumonia, and she had to lay there for 30 days. And I don't know where she gets the money to pay the bill, but she figures out the money, and she comes up with a way to pay the bill. And they discharge her. And she's home for another 2 weeks, and wouldn't you know it, she falls down the stairs and breaks her other hip. She has still not been home for 60 consecutive days. So she's still in the same benefit period. But she's over here in the last piece called the lifetime reserve days. And the lifetime reserve days provides her a hospital stay of 60 days. But during that period, she's going to have to reach in her pocket and pay twice as much per day as she paid here. So let's recap mother's visits. Mother fell and broke her hip. She went into the hospital. Her benefit period begins. She has to pay a benefit period deductible, and Medicare pays the entire hospital bill other than that for the first 60 days. She goes home. 2 weeks later, she comes down with pneumonia. She's back in the hospital, but she's reaching in her pocket to pay more. And if she's there for 30 days, fine, that's what happens. They discharge her. 2 weeks later, she falls down the stairs or breaks her hip. She's over here. So the maximum benefit period is 150 days. Once mother has been in a hospital during a benefit period of 150 days, Medicare doesn't pay anything. Well, people say, well, people don't lay in a hospital for 150 days. That's true. But they are in and out. As we get older, we're in and out. And it's possible to burn up those days. So I want you to understand one thing here. What is the maximum benefit period in Medicare? Part A. 150 days. When does a benefit period begin? When a person is admitted to a hospital. When does it end? When they've been discharged for 60 consecutive days. That's really what you need to know. So Medicare also has what's called a skilled nursing benefit. So when mother came out of the hospital with that broken hip, they probably wouldn't have sent her home. They would have sent her to a nursing home so she could learn how to walk again. That's what the skilled nursing benefit is for. It's to help her learn how to walk again. But it's a maximum of 100 days per benefit period. The first 20 days, Medicare pays 100% of that skilled nursing benefit. But the next 80 days, she's going to reach in her pocket and pay a copay. It's closer to $150 a day today. So what do you need to take away from this slide? How many days per benefit period will Medicare pay for skilled nursing? Answer, 100. How many days will it pay in full? 20. That's what you need to have. Also, before Medicare will pay any benefits in a skilled nursing facility, there's a prerequisite, if you will, that must be met. The patient must have been in a hospital for at least 3 consecutive days somewhere in the last 30. That's what that line is trying to tell us. So if mom is home and the doctor says you need to go to a skilled nursing facility, Medicare is not paying for it. She's going to have to go to the hospital, get admitted, pay the deductible, lay there for 3 days, and then they can send her to their nursing home. It's kind of crazy, but that's what could happen. Part A also has a home health care benefit. Home health care benefit. It's an unlimited number of visits. Unlimited number of visits. Now, this is a visit, not like a mother-in-law visit where they come and stay and stay and stay. No, this is a visit where they come, they do something that's medically necessary, and then they leave. And you can have an unlimited number of those kinds of visits under Medicare Part A. However, this visit must be provided by a Medicare-approved home health care agency. We just can't call up someone on the nurses registry or call up our niece who happens to be a nurse and have her come in and do this and have Medicare pay for it. No, no, no. It must be someone that is employed by a Medicare-approved home health care agency. Part A also has a hospice benefit. A hospice is a place where people go to make a final transition. We touched on that a little earlier. Don't worry about the 210 days. That's been changed. I should get rid of that. But the purpose of hospice is to relieve pain and suffering. If a Medicare beneficiary is in hospice, it's anticipated they're probably going to die within 210 days. That's what the 210 days is about. It's not a hard and fast rule, but that's generally the rule. But they're not going to give them any medications that will help them get better because they are considered to be terminally ill. There is no getting better. So they will only provide treatments to help relieve pain and suffering. They will also provide respite care for the family caregiver, because many times that terminally ill loved one is being cared for by a loved family member at home, and that family member may need a break. We talked about respite care and we talked about long-term care. So treatment for the relief of pain and suffering. A word you may see on the test, palliative care. Palliative care is the word that means relief of pain and suffering. Palliative care. P-A-L-L-I-A-T-I-V-E. Palliative care. Part B is the medical. Part B is medical. Remember, it's additional, optional, additional premium. It'll help pay the doctor. Part B has an annual deductible. Remember, Part A has a benefit period deductible, but Part B has an annual deductible, and that changes every year. I just give you a number to have you something to relate to. And Medicare Part B will only pay up to 80% of its approved charge, and there's no out-of-pocket limit on the beneficiary's 20%. And I stepped you through a little bit ago on how they come up with this approved charge. Doesn't matter what the bill is, they're only going to pay 80% of its approved charge. And then, of course, Part B will pay for prescription drugs if they're administered by the physician. And I have A and B in parentheses to remind you that will provide also Part A, but not self-administered. Part C, as we said, is Medicare Advantage. These are HMOs and PPOs, managed care plans purchased from private insurance companies. They're still in Medicare. Don't let the test confuse you. And why do people do this? Because the way these are set up and the premium that's paid makes it a lot easier for the senior citizen to budget their health care costs. There are some Medicare Advantage plans where the premium is zero. And if they go to the doctor, they pay $25. It's very, very easy for people on fixed budgets to get some good medical care using Medicare Advantage plans. PFFS, forget that. That shouldn't be there. Matter of fact, I'm going to get rid of it. Now, where I say special consideration for Medi-Medi, what am I meaning? Well, even though they're pretty inexpensive, those people that are old and broke, that's what Medi-Medi means Medicare, they're old, Medicaid, they're broke. There are both Medicare and Medicaid. There are, unfortunately, in America, too many senior citizens that are on both Medicare and Medicaid because they're broke. That's sad. But there's special consideration when it comes to any costs they may have to incur. Okay. If there is a premium, Medicaid might help pay it. The copay, they need to go to the doctor, and Medicaid might pay it. Okay. Part D, prescription drug plans. Recap. These are policies of insurance issued by private insurance companies. Senior citizens don't have to have these if they don't want them. They're optional. But if they don't enroll when they're supposed to, they'll pay a 1% penalty. All of these things need to be enrolled in within 6 months of enrolling in Part B. Within 6 months of enrolling in Part B. If they don't buy a Medicare prescription drug plan within 6 months of enrolling in Part B, they're going to pay a penalty. You need to know the penalty is 1%. Okay? These prescription drug plans, the last bullet is what's important. They have annual deductibles and monthly premium. The average monthly premium across the country is about $38 a month. Now, there's another question that shows up. Primary, secondary payer. We're talking about a concept called coordination of benefits. Coordination of benefits. If somebody is 65 or older, remember they're automatically on Medicare Part A, and they may still be working, and they may have group insurance at work. So someone who is 65 and older and covered at work with a group plan, the group plan is the primary payer and Medicare will be secondary. Because you see, they get Medicare Part A automatic and mandatory at no additional premium. So they have Part A because they're 65. And if they're still working, they got group insurance at work, they got that. They have both. They don't get paid on both. The group plan will be the primary payer, and whatever the group plan doesn't pay, Medicare will come in and help pay the balance. The employer who has that group plan cannot offer any incentive for that Medicare beneficiary to drop the group plan. The Medicare beneficiary can drop the group plan if they choose to. The point on the question is the employer cannot offer any incentive for that beneficiary to drop the group plan. Medicare supplement policies. Medicare supplement policies. I mentioned to you that Medicare Part A and B doesn't pay all the bills, and as we went through this, we showed you there's deductibles and copays and coverage periods and all that stuff. So it doesn't pay all the bills. So some people who have traditional Medicare will buy a Medicare supplement policy to help fill the gaps to pay what Medicare doesn't pay. That's why they refer to them as Medigap policies. They're designed to pay some or all of Medicare deductibles, coinsurance, and copays. So Medicare, remember the Part A deductible, the Part B deductible. There's coinsurance and copays. Well, Medicare supplement policies, depending upon which one you buy, pay some or all of those issues. They are issued by private insurance companies, and there's a premium you have to pay. But a Medicare supplement policy must meet certain standards. And those standards are set. Here we go back to the National Association of Insurance Commissioners again. The National Association of Insurance Commissioners has created a model law that spells out what must be covered in Medicare supplement policies. Now, this could show up on your test. Consider this. The older we get, unfortunately, health begins to deteriorate. And Medicare supplement policies are issued by private insurance companies, and they will normally want you to qualify medically to get it. However, there's a special window of opportunity for senior citizens to get a Medicare supplement policy without any consideration or concern about their health. Let's see what it says in that last bullet. No medical requirement if the beneficiary enrolls within 6 months of enrolling in Part B. So let me restate it. Any Medicare beneficiary who enrolls in Part B has 6 months from the time they enroll in Part B to buy a Medicare supplement policy, and it doesn't matter what their health is. They could be in a hospital. The insurance company's got to issue the policy. They can't charge them more money because they got a health problem. Guaranteed to be issued as if you were healthy. So most people who are just enrolled in Medicare Part B would be wise to investigate a Medicare supplement policy. They got 6 months to take advantage of that benefit. If they wait beyond 6 months of enrolling in Part B, they're going to be what we say medically underwritten, and they could be turned down. The plans are lettered, and don't worry about the letters. Different plans have different letters. Not all plans cover the same thing. What I need you to cover is, get this, hold on. Let's go to Medicaid. That's it. Medicaid. Remember, Medicaid is a program of health insurance for the poor. So there's both federal and state funding on Medicaid. Typically those who, AFDC is an old program. It stands for Aid to Families with Dependent Children, but it's designed to imply that these people are not doing well financially and they need help. Not bad people, just people having tough times, okay? So those on welfare will get Medicaid. Now, here's where the test question goes about Medicaid. Long-term care insurance provides benefits if we can no longer live an independent lifestyle, right? Well, people on Medicaid can't afford those policies, but Medicaid will provide benefits to those on Medicaid if they need help with the activities of daily living. However, they got to be at least a citizen or have a legitimate green card, and they have to go to a nursing home. They're not going to be allowed to stay home. People say, well, why wouldn't they be allowed to stay home? Isn't it cheaper to care for them at home? No. It's the difference between having a private trainer and going to a gym. So Medicaid says, yes, we will help a person on Medicaid cover the costs of having somebody help them with the activities of daily living, but they have to go to a nursing home. It's cheaper to warehouse them than it is to take care of them individually. Now, one of the things we discussed in the course of our time together is Social Security Disability, SSDI. Now, how does somebody qualify? One of the questions you may get is, how does someone qualify to get a Social Security Disability benefit? Well, I'm going to tell you it's not easy. It's a very restrictive definition, a tough process. So here are the steps that need to be accomplished. First of all, the person must be classified as fully insured. That isn't a big deal for most Americans. That means they have to earn enough money in 40 calendar quarters over a lifetime. And then the second step is they must be disability insured. And disability insured means if they apply for SSDI, the Social Security Administration is going to look back over the last 40 quarters of their life, the last 10 years, and they're going to make sure they've earned enough money in 20 of them. And that's generally not a difficult thing for most people to qualify for. Now, it is a problem for those who are young. If you're too young to have been on Earth long enough to get the quarters, they will adjust this for age. And we're going to talk about this adjustment for age in a minute. But by and large, the first two are not that tough. It gets tough in the third one, because Social Security says to get this SSDI benefit, you have to be unable to perform any job that exists in the national economy. You have to be so bad off that you can't even make $500 a month. That becomes a problem. In addition to that, They say that the disability must be the type that's going to last at least a year or end in your death. So we're not talking about a broken arm here. These are severe and serious disabilities. Now, another thing you got to know, once the person gets approved, so the Social Security says, all right, you qualify. Great, when am I going to get my check? Well, you got a 5-month waiting period. From the time you get approved, you got a 5-month waiting period, and you get your first check in the 6th month of approval, after approval, and it's not retroactive for the 5 months you waited. You may get a test question about this. If a person qualifies for SSDI, how long do they have to wait to get their first check? 6 months. They got a 5-month waiting period. They get a check in the 6th month, and that check is not retroactive for the 5 they waited. Now, once 24 months, this is important for you to grasp. 24 months from the time they get their first check, they qualify for Medicare. Because remember, once someone's been collecting an SSDI check for 24 months, they qualify for Medicare. So they count the 24 months starting right here once they get that first check. I mentioned to you that they adjust it for age, and this is in your slides as well, I'm pretty sure. So if somebody is under 24 and is so disabled they want to get an SSDI check, then they only have to earn 6 quarters over the last 3 years. And if they're between 24 and 31, they're going to get credit for half the years they worked. But that's not where the test question goes. The test question goes based upon this chart. Here's where their question, here's something you may get, typical question you may get. Mary is 50 years old. How many quarters of credits will she need to qualify for SSDI? Answer, 28. She doesn't have to get 40, she needs 28. If she's 51, she's going to need 29. The chart is in 2-year increments, but we live in 1-year increments. Now, you may get a question on the test that addresses what I just went over. And I got a feeling you're probably like me, not being able to memorize that chart. But here's what I'm going to suggest you do. Memorize the starting point. 31 to 42 equals 20. When you sit down at the computer, they're going to give you some plastic to write on and a kind of a grease pen. One of the first things I would do is write down 31 to 42 equals 20. And then if I get a question similar to what I just told you about Mary, you can count on your fingers to get the right answer. You don't need to memorize the chart. But I wouldn't wait until I got the question before I wrote that down. I'd write it down while it's fresh in my memory so I'm not all discombobulated. So understand how that works. Don't worry about primary insurance amount. Now there, we've already covered this. There's nothing new here. Other health insurance concepts. Other health insurance concepts. We already discussed some of this. We're going to review it, and there's going to be some new stuff. The owner, as we have said to you more than once, has all of the rights. The right to name and change beneficiaries. Make any other change with that contract. As long as the insurance company agrees, they don't need consent of the beneficiary. The beneficiary has no standing in this contract. We already talked about the fact that beneficiaries can be revocable or irrevocable. I'm not going through that mess again, but make sure we understand the difference between revocable and irrevocable and the idea of a vested interest here. Now, when we name beneficiaries, we name them in an order. I think we discussed this, but we're going to quick touch on it again. Who or what can be a beneficiary? Any entity capable of receiving money. And remember, beneficiary means first, not only. Then we have contingent beneficiaries, all right, secondary and tertiary. I know we discussed that. Modes of payment. We've already talked about that as well. But here's what we have not discussed. Let's assume we have a situation where we have a family, mommy and daddy and baby. And daddy works for company A and they have group insurance. And he's covered under that group plan at work. And his wife is covered by another company and their group plan at work. And they have decided they have decided that they're willing to pay the premium to become a dependent on their spouse's group plan. They can do that if they want. And what would happen, there would be a coordination of benefits, meaning that if dad becomes sick or hurt, his policy will be the primary payer, and then his wife's policy will pick up what his policy doesn't pay up to its limits. Coordination of benefits. The question, however, comes up, what happens if baby is dependent on both policies? Which policy is going to be the primary payer, mom's or dad's? Well, Virginia uses what's called the birthday rule. And here's how it works. Whichever parent birthday occurs first in the year, that parent's policy will be the primary payer. Not who's oldest or youngest, but whichever parent birthday occurs first in the year, that parent's policy will be the primary payer, and then the other spouse will be the second policy with the secondary payer. Some states use the gender rule, where dad's policy is primary. Not in Virginia. Virginia uses the birthday rule. Occupational versus non-occupational. Health insurance policies are identified as well by this method. An occupational policy is one that covers you 24 hours a day, both on and off the job. These are only available to those of us who are self-employed because we don't have workers' comp to help us while we're working. A non-occupational policy, I alluded to this earlier today, a non-occupational policy will provide benefits for off-the-job injuries and illnesses only. So if somebody has a group plan at work, it's going to be called non-occupational because they have workers' comp to provide benefits for work-related illnesses and injuries. So occupational, non-occupational. We already discussed this. Let's kind of review it again. Medical insurance premiums are always tax deductible. Remember, those of us that are self-employed and employers get to deduct 100%. But any employee, they can only deduct the amount that exceeds 10% of their adjusted gross income. With disability income insurance, if an employer is paying it for their employee, they get to deduct all of it. Employees don't get to deduct any premium they pay for any policy that they benefit from. Remember the payer and the recipient deal? Long-term care insurance, employer, again, gets 100% deduction for premium they pay for their employee. But now, this one's a little different. With long-term care, the employee can only deduct the amount that exceeds 7.5% of their AGI. This is really strange, but I don't shoot the messenger. See, typical medical insurance, it's 10. Long-term care insurance, if you're paying any premium, you can only deduct the amount that exceeds 7.5%. I wish we didn't have to go through this, but you do. And then the benefits. Medical insurance benefits from medical insurance, always income tax free. Disability insurance, it depends upon, remember, who pays. So any benefit you get from your employer's contribution, you got to pay a tax on it. Any benefit you get from your contribution is tax free. Long-term care insurance is treated like regular medical insurance. The benefits are income tax-free. So this is one of the weird ones. You can get a tax deduction and you still get benefits tax-free. Now this is a typical generic question that may help you with clearing up the cobwebs about what we just went over. Let's assume John has a disability income policy. His employer pays 75% of the premium and he pays 25% of the premium. He becomes disabled. The benefit's $1,000 a month. The question is, how much of that benefit is taxable? Well, before I lay the answers down, let's look at the question. How much is the benefit? $1,000. How much of the benefit comes from the employer contribution? 75%. What's 75% of $1,000? $750. So that's our answer. So the employer pays 75%, the benefit's $1,000, 75% of that $750. If the question says the employer paid 100% of the premium, then the answer is A. If the question says the employee paid 100% of the premium, then the answer is D. Just see, it's a matter of who pays and who gets. Total disability. How do we define total disability? There are two different definitions of total disability. One is referred to as the own occupation definition, and the other is referred to as the any occupation definition. Own occupation, what does it say? We'll pay you a benefit if you're unable to perform any of the duties of your own occupation based upon education, training, or experience. So let's assume we have a dentist. He buys a disability income policy. It happens to use the own occupation definition to define total disability. And he hurts his back so bad he can no longer be a dentist. But he can teach at a university based upon his education, or who knows what, he can do a lot of things. But it doesn't matter. He's still going to get a benefit from his policy, because the definition says what? We're going to pay you if you can't perform any of the duties of your own occupation. And his own occupation was that of a dentist. Now, some companies, more companies actually, use the any occupation definition. Now they're saying the same thing. We'll pay you a benefit, but only if you can't perform any of the duties of any occupation. So this same dentist who hurts his back, if he has a policy with the any occupation definition, he can get a job teaching. His policy is not paying him a benefit. So the any occupation definition is a more restrictive definition, isn't it? Just like earlier today, we talked about means is meaner, more restrictive. Well, any is more. You may get questions about which one of these is more or less restrictive. Partial disability, that's when you're unable to perform one or more of the duties of your own occupation. Rarely does this show up on the test. We have talked about residual. Remember, it's not a type of disability, but a method of determining how much will be paid. And it's what? Based upon the percentage of pre-disability income that's lost. This has replaced that issue of partial. And this is a recap of what we did, right? He earns $5,000 a month, benefits $3,000. He's totally disabled. That means he's lost 100% of his income. The residual benefit says he's going to get 100% of his benefit. If he goes back to work and earns half his income, he's lost half his income. So the policy is going to pay half its benefit. We've already been through it. We've been through that. We talked about recurrent or relapse. Nothing new there. Remember, it was 6 months, nothing new there. Managed care, we're going to skip right through that, not that important. Workers' comp, we've already been through that. I've got extra slides in here. I should be getting rid of them. Subrogation. So guess where we are, ladies and gentlemen, for today. We are done for today. Tomorrow morning, we're going to meet for about 3 hours. And we're going to discuss the law part. It won't take us quite 3 hours. It's about the law, and you need to know it. So we're going to take that time to do that tomorrow. So you're going to get a break. You're going to get it off a little early today. It's 2:30. We haven't taken any breaks, so we pushed you pretty hard. I would recommend, ladies and gentlemen, that you get on License Coach ASAP. Don't wait to get done with this. Get on License Coach and start doing those practice tests like I explained to you. Start after it. Find out what you remember. Find out what you don't remember. And then look at those videos and audios to help you remember. That's going to be your best tool. You're off early enough, you should find time to do that. I will email each of you the link for the new login tomorrow. Now, I don't have one of your emails. I'm sorry, I can't remember your name, and you have to forgive me. The older I get, the harder it gets for me to remember names. Okay. Lachey, I don't think I have your email. You started to give it to me, and I asked you to email it to me so I could get it. I don't know if you've emailed it to me, but if you could email it or text it to me, I will get you your own personal copy of the License Coach instructions and your own personal invitation to come to the webinar tomorrow. So unless there are any specific questions, we're going to call it a day. and we'll talk tomorrow morning, 8 o'clock. We should be done by 11. Have a great day. I appreciate your time, but we're going to sign off for now. Unless you have a question, I'll hang in there for a minute. Okay.